Hi, and thank you for joining us today for our Uranium Conference 3.0. At Bloor Street Capital, our purpose is to educate and inform our investors on where and what to invest in. We work with some of the best mining companies in the world, and we seek out the best portfolio managers and industry experts to help guide you through this process. Today, we have brought together an amazing lineup of industry experts and companies focused on uranium. Our conference sponsor is TradeTech, which is the leading independent provider of uranium prices and nuclear fuel market information. For more information on their services, there is a link below in the description. Our conference begins with John Ciampaglia of Sprott Asset Management. John will provide an update on the Sprott Uranium Physical Trust, the North Shore Uranium ETF acquisition, and what he is seeing in the spot and term markets. Then we will hear from David Cates of Denison Mines. Denison is an advanced developer focused on the eastern portion of the Athabasca Basin with its flagship property, Wheeler River, which is advancing toward a feasibility study, and David will provide an update on that process. Then we will hear from Tim Gabruch of ISO Energy. ISO Energy is focused on the eastern portion of the Athabasca Basin and is currently undergoing a drilling campaign with 2 rigs focused on its Hurricane deposit. ISO Energy has a total of 24 projects, and Tim will highlight which other projects he is focusing on for the upcoming summer drill program. Up next is Leigh Curyer of NexGen Energy. NexGen is the largest and most advanced developer in Canada and is focused on the southwestern portion of the basin. NexGen's flagship is the Arrow project, and Leigh will provide an update on the release of the environmental impact statement, as well as an update on NexGen's exploration project. Then we will hear from Andre Liebenberg of Yellowcake plc. Yellowcake buys and holds physical uranium and is listed on the London Stock Exchange. Yellowcake has a strategic relationship with the world's largest uranium producer, Kazatomprom, and Andre will provide the details of that relationship. Up next is industry expert Justin Huhn of the Uranium Insider, which is the only newsletter focused on the uranium industry. Justin will provide an overview of the importance of enriched uranium and how it's being impacted by the current geopolitical situation, as well as ETF flows and equity valuations. If you have an interest in Justin's newsletter, there is a link below in the description. Then we will hear from Paul Ma of CGN Mining Group. CGN Mining is a sub of China General Nuclear Power Group, which is the 3rd largest nuclear utility in the world. And Paul will provide an overview of China's nuclear build-out, as well as CGN's mining and trading operations. Our next speaker is Askar Batyrbayev of Kazatomprom, and Kazatomprom is the world's largest uranium producer. Askar will provide an overview of Kazatomprom's 2021 financials, guidance for 2022, an update on the ANU fund, and an update on how the current geopolitical situation is impacting transportation of uranium to its Western clients. Our conference ends with Grant Isaac of Cameco, which is the world's 2nd largest uranium producer. Earlier this year, Cameco announced the restart of its flagship mine, McArthur River, and also announced the signing of long-term uranium commitments for 40 million pounds. And we will discuss these positive events with Grant. This conference is about educating and informing, and one more resource I want to bring to your attention is John Quakes, an online research analyst, and though John is not presenting at this conference, he provides an invaluable information on the uranium sector, and you can learn more at his Twitter account at Quakes99. Don't forget to subscribe to our channel, Bloor Street Capital, and hit the notification button so you can be kept up to date on upcoming events. I hope you enjoy the conference. Hi, John. Thank you very much for joining us today. How are things in Toronto?
Hey, thanks for having me. Appreciate it. Slowly getting back to normal in Toronto, and the financial district is definitely showing more signs of people returning to work, which is great.
That's good to hear. John, let's start with an update on the Sprott Physical Uranium Trust. When you and your team took it over in July of 2021, its net asset value was around $600 million and it held 18 million pounds of uranium. Where does it stand now?
Yeah, sure. So it's been an incredible journey in a very short period of time. The Uranium Trust right now has about 53 million pounds of U3O8, and we've added about 11.6 million pounds so far in 2022. So we continue to see good interest from investors around the world. We also crossed the $3 billion net asset value mark, which is a great milestone. But I think more importantly, it's important because as the fund has become bigger, it's attracted larger institutions to get involved in the trust. And one of the things we've realized over the last few months is that we talk to institutions around the world that are interested in uranium, they do their homework on the thesis, and then they want to express their view. And they find that there aren't a lot of options. You know, outside of Cameco and Kazatomprom, the two biggest producers, the market cap of many of these companies is still quite small, given, you know, a 9-year bear market that we've worked through. So as our trust gets bigger, it seems to be attracting a bigger range of institutions.
Yeah, I'm glad you brought that up because just last week, I believe it was last week, but Caxton, which is a large macro fund based out of New York, they managed approximately $4 billion in AUM. They recently filed that they purchased $250 million worth of spot. And so just along that same vein, are you getting a lot of calls from hedge funds and long-only funds about this product or family offices?
Yeah, absolutely. I would say that most of the interest we're seeing are actually from institutional investors and family offices. Yes, there is a growing number of individual retail investors that are interested in the trust, but the really big chunks of money that have come in have been from institutions right around the globe. Caxton is one that we've been in touch with for many months, and they've been slowly adding and building their position as they become more bullish. I think a lot of hedge funds and institutions starting in January became increasingly bullish as things around the world started, unfortunately, to crack. First in Kazakhstan with unrest, and then more recently with the invasion of Ukraine by Russia. It seems to be very global in interest, and we've been talking to funds all around North America, Europe, Asia, and you know, this morning, for example, I got off a call with a couple of hedge funds in Brazil. So the interest is very global in nature.
And what about your typical generalist firms like Fidelity or Wellington or CapRe? Are you seeing interest from these types of funds?
Yeah, I would say it's more sporadic. I think the macro funds, the energy transition funds, they've been much more in tune with this whole broader theme of decarbonization, energy transition, and they've done their work on and research on the uranium space. So I would say we're still in the very early stages of broad adoption by generalist investors. So I think there's a lot, you know, there's a really big opportunity here as interest grows. Obviously, with things happening in Ukraine, sanctions with Russia, it is bringing a lot of attention. Just yesterday, you know, the Minister of Natural Resources for Canada was speaking about how Canada can help and meet the shortfall in uranium and other things like potash as the world moves away from Russian supply. So this is getting a lot of attention. In the last few days, I think the Wall Street Journal wrote 2 different articles about uranium and uranium mining. So when the big publications are talking about a topic, you know, it's not too far behind that you get more and more inbounds.
And along that same point, Goldman Sachs just went bullish on uranium recently, and that's also going to create a lot of exposure and interest.
Yeah, for sure. I think as these research houses put out reports on different commodities, because remember, many investors around the world have been hugely underinvested in commodities for the last 10 years. This supply disruption from COVID and more recently with Russia, Ukraine has really highlighted how susceptible a lot of these commodity supply chains are, how underinvested they've been for 10 years. and how it's now creating all kinds of disruptions. So I think investors are thinking very differently about commodities, not just uranium, but a whole slew of different commodities that, quite frankly, have been completely ignored and unloved for many years.
So let's move on and just talk about the ATM. This is one of the interesting features about this product, but where do you stand? How much cash have you raised year to date? And remind me again what the cap is.
Sure. So the shelf prospectus that we filed and then upsized in 2 subsequent times allows us to raise about $3.5 billion US in the trust. I think we're somewhere around 1.5 billion through that. So we've got more room to run, and this is not a finite limit. Once we run out of that capacity, then we simply go to the regulator and reload another amount to the shelf prospectus. But we did just shy of 1 billion last year, and I think we're somewhere, I've lost track because it's been so busy, but we're probably approaching 500 million for 2022.
So let's move on and talk about the New York listing. Where do you stand there?
Yeah, so we've continued to go back and forth with the New York Stock Exchange on the filing. I do have an update call with them on Monday. So I'm hoping to get an update on where we are with that. There's clearly a number of things we're asking for exemption from the SEC with respect to some of the, the attributes of the trust, and that process is ongoing. And we hope we can get it over the line this year.
And did you lock up the symbol SPUT or SPUT?
It was taken, unfortunately.
So let's move on. North Shore, let's talk about it and provide the listeners with an update on what's happening here.
Yeah, so as I talked earlier, in terms of the investability of uranium as a whole, investors can buy vehicles that own physical uranium, or they can invest in the miners, everything from producers to developers to exploration companies. And so the North Shore Global Uranium Mining ETF trades on the New York Stock Exchange with the ticker URNM. We've made a proposal back in November to acquire that fund and reorganize it to become the Sprott Uranium Miners ETF, and that proposal requires 50% of all the shareholders of record on December 15th to vote their shares. And as you can imagine, there are a lot of investors in the fund, and it takes time to get people to pick up their phone or go to the website, put their control number in, and vote their proxy. So we are very, very close to achieving that 50% quorum. I think as of yesterday, we were at 46-point-something%. And we had some more shares come in this morning. So we're very close. So if a shareholder of record of December 15th owns shares and has not voted, please go to our Twitter feed. We have some 1-800 numbers there that you can call to do that. And but on the theme of investing in uranium equities, I think this is really interesting because we recently did a study and said, what's the market cap of all the uranium companies that we can find that are publicly listed? And there's about 80 of them, 83 of them. And the market cap is just over $30 billion US. So that you could essentially buy all 83 companies if you had $33 billion. Now, if you contrast that to, say, the market capitalization of Exxon alone as a single company is 10 times that amount. Let's go down the food chain in terms of another oil and gas company, EOG Resources. The market cap of that company is 2 times the 83 companies combined. So I use this as an illustration to highlight how small the investment universe is to other forms of energy production and generation. And this is a result of a 9-year bear market and many companies basically disappearing over time from the last cycle. So institutions are looking to get invested in this sector, and what they find is that it's still a very small size. That size is clearly going to grow because there's going to be much more capital going into the sector. There's way more investment and interest now with uranium at $58 than uranium at $28. So we see a lot of growth in those companies. We see a lot of projects finally coming back online in the years to come. And there's a lot of interest in the uranium equities as well.
You bring up a very good point because, as you said, the spot price is around $58, give or take, but yet we're nowhere near the all-time high of $140 that we saw back in, was it '07?
'07, correct.
Right, so the level of interest that we saw back in '07 was significantly more than what it is right now, and yet the whole backdrop to investing in this space is so much better than it was back then. And so if I was to use a baseball analogy, what inning do you think we're in?
I think we're starting the second inning.
So
Last year was kind of last year was the first inning, like literally getting out of the batter's box and getting out to the plate. So last year was a transformational year where you saw what we believe was the true price inflection in the spot market when we started to break away from $30 and then achieve $40 and so on. This year it's about building on that, and more importantly, I felt that 2022 was all about looking for signals from the term market. And what I mean there is, are we seeing contracts being done, more of them, bigger sizes, and at higher prices than we've historically seen? And I think so far in 2022, we're seeing all those signals. We're seeing more and more utilities go to the major producers and say, look, I need security of supply, not today, because that's not how the uranium market works, but I need security of supply starting in 2026 and going all the way out to 2032, for example. We're seeing, I think the best signal we've seen in the market so far is from Cameco, that announced in February that their contract book last year for the entire 2020-21 was 30 million pounds. And at that point in February, which was about the midway point, they'd already booked 40 million pounds. So that was the signal we've been waiting for and watching for. Are the utilities coming back and feeling anxious about security of price and supply? And for utilities, this security of supply issue has changed dramatically in the last 3-4 weeks, obviously, because with their dependence on Russia for enriched uranium, this really changes the whole dynamic for them. So whether there's sanctions or not, whether Russia withholds the material as a countermeasure, or whether an individual utility opts to self-sanction. And I've heard this from a number of utilities that said, we have deliveries coming from Russia, we are reneging on them. So this crunch that's coming in the enriched uranium is real, and it impacts the utilities greatly. How are they going to make up the shortfall? Well, they're going to look for enrichment facilities in France and the United States to make up the difference. But there isn't like a whole ton of capacity that's sitting there idle to make up the shortfall. And this capacity will be supported by Western facilities, but it's going to take time, and it's also going to take a lot more U3O8 and UF6 to facilitate that supply deficit, to meet that supply deficit coming from Russia. So we think this is another key factor that's going to play out in 2022.
very interesting comments about the term market and what utilities are doing. Now, what about the spot market? I'm kind of curious, are the traders at WMC, are their phones ringing off the hook, or do they have to go looking for supply? Are people holding back on product?
Yeah, so I mean, we're such a material buyer of uranium that anybody that has uranium to sell generally has our phone number. So we find that we have to reach out to them less and less. But what we've noticed in the last few weeks is, as soon as there was chatter about Russian enrichment being sanctioned, and there was a bill put forward by a U.S. senator to do that recently, we noticed that as soon as there was concern about potential sanctions, the market became much tighter. People seemed more reluctant to sell their pounds because just the unknown of what could happen, what's the potential disruption. So we are finding the market to be a little thinner and people a little bit more sensitive about letting their pounds go into the market, given there could be another supply disruption here on the enrichment side.
John, I want to digress from uranium just for a moment. Many of our followers and yours have an interest in gold, and the Sprott name is synonymous with precious metals. So I can't let you go without getting your thoughts on gold. And gold's only up 5% on the year versus uranium, which is up 30%. Yet inflation's trading at levels we haven't seen in decades. But when are we going to get a uranium-like move in gold?
Yeah, I mean, it's a very different market, and it's and then the reason for that is because there's a massive stockpile of gold sitting around in vaults around the world. So it doesn't have the same supply demand, fundamentals and supply chain that uranium has. But nonetheless, we know that when there is a run on gold or the high demand for gold, it can create dislocation in the marketplace and push the price up. So we've seen a big shift in our business in terms of interest in physical gold and physical silver so far in 2022. And last year was a fairly quiet and soft year for physical gold investments. If you look at all the big gold ETFs last year, most of them all had net outflows. The GLD was about minus 10 billion last year. So that's just a reflection of people, back to equities, back to tech stocks, back to risk on mode last year. That's clearly shifted this year, where many of these stocks have corrected pretty sizably, and people are thinking much more differently about their portfolio risk. So we've seen a lot of interest back in our gold and silver trusts. So we think it's starting. It feels like kind of inning one of the leg up.
So there's hope for us gold bugs.
There's always hope.
John, I want to thank you for spending time with us today. That was a very insightful conversation. And if we have any North Shore shareholders watching, please get out and vote your proxy. Once again, John, thank you.
Yeah, thanks for having me. Appreciate it.
Hi, David. Thank you very much for joining us today.
Jimmy, my pleasure. Always happy to be here with you.
David, we were just speaking with John Ciampaglia of Sprott, and he's also based in Toronto, and he mentioned that things are slowly getting back to normal in the financial district. Do you have the same observation?
Yeah, Jimmy, I'm seeing more people wanting to be in the office and a little more foot traffic out there, and definitely the same sort of report out of Saskatoon, where we've got more of our folks in that office coming back, and things are resuming more normal for sure.
Yeah, it's good to see things getting back to normal, and we're speaking with a lot of people today that are based throughout the world, and it's just interesting to see how different cities and different countries are moving ahead.
Yeah, definitely agree, and we've got networks out there too, and starting to do a little bit of investor roadshow marketing and conferences at the same time. So people really enjoy both this combination of being able to talk virtually and then in person as well.
David, a lot has happened since the last time we spoke, not only within the uranium sector, but also at Denison Mines. And before we get an update, why don't we just start with a brief overview of Denison Mines for those investors who might not be familiar with the company?
Yeah, for sure. Look, Denison has a long history. We're a uranium developer and explorer. We're focused in the Athabasca Basin region in northern Saskatchewan. And we are traded on the TSX under the symbol DML and on the NYSE American under the symbol DNN. Our focus is a project called Wheeler River. We have an effective 95% interest in this project, and it's currently going through the environmental assessment and feasibility study work to be the next new uranium mine in the eastern portion of the Athabasca Basin.
David, as you mentioned, your primary asset is Wheeler River, and it's comprised of two different deposits, the Phoenix and the Griffin. But in the interest of time, I want to spend more time on the Phoenix deposit. And one of the unique features of this deposit is that it's going to be mined by the ISR mining method, which is also the same method that Kazatomprom uses in Kazakhstan. It's highly profitable, great economics, And before we dive into the project itself, why don't you just give us a brief overview of ISR mining, and just so we have a better idea of how it compares to traditional mining methods and how much more economic it is.
Thanks, Jimmy. There's really two parts that drive ISR mining to the top of the heap when it comes to the most profitable mining methods, and it's on the CapEx and the OpEx side. And a lot of it just has to do with the intensity of that capital to build this type of mine. And it's totally different than conventional mines, and that's why the CapEx profile is so different. Instead of a large open pit or significant capital associated with a shaft and underground mine workings, ISR is doing everything from surface. And so it's a series of borehole wells that are drilled from surface, encased with screens at that desired depth where you've got your ore body. And what you're doing is injecting a mining solution into the injection wells, and you're forcing that solution through that host rock, which has to itself be permeable and be able to take that solution and allow it to travel through. As the solution travels through that host rock, it's dissolving the uranium that's in the ground, and then you're using a series of recovery wells where you're pumping that uranium-rich solution back up to surface. And when you're on surface, now you've bypassed most of the costly and capital and OpEx intensive work in mining because you've already got a leach solution. So you've already come through the mining process, more than half of the milling process, and now on surface you're really just processing that uranium-rich solution to a finished product. In our case, we have such high grades in the Athabasca Basin and at Phoenix that we were even able to bypass things like SX or ion exchange and go direct to precipitation, which is that second prong, which is OpEx. It really keeps our OpEx very low because we're doing very little in terms of processing that, precipitating out that uranium from our solution and finishing it through drying or calcining to a finished product. So it's a simpler process. You can see there's just less capital involved, there's less operating costs involved, and that's part of why we see the ISR mining method dominating our industry today, with over half of the world's production coming from the mining method.
And David, a big element of the Denison story is one of de-risking the Wheeler River project, and you've done that with the pre-fees and also with the commencement of the feasibility study. And you've also done a lot of field work, including the completion of the ISR field test program. And without getting too technical, why don't you just give us a brief overview of that program and what the results were?
There's no mystery that what we're doing is a little bit unique. We will be the first in situ recovery uranium mine in the Athabasca Basin, and so our focus has been on de-risking. And we've been doing it systematically, step by step, over the last 3 years, progressing the sophistication of our test work to the point where in 2021 we completed a commercial scale pattern test. So not only did we complete this test, but we set up the test, in the first place. So that meant that we installed 5 commercial scale wells right into the Phoenix ore body in what would be our first phase of mining. We also installed a series of monitoring wells around that. Now we have many monitoring wells and other small diameter test wells in the area, but the focus was operating this 5-spot commercial scale pattern. And the results were really fantastic. Number one, we were able to achieve commercial scale flow rates that corroborated what were in the pre-feasibility study. Number two, we introduced a tracer element. And so this is, basically an inorganic salt that we're able to trace through total dissolved solids at each of the monitoring wells to verify that the solution we injected is the solution we're recovering. And in doing that, we could see that we had complete control over our pattern. It meant that we didn't recover the tracer element in the monitoring wells, but we did recover it in our commercial pattern where we wanted it to go. And because of that tracer, we were also able to establish breakthrough times. So we've done years in that systematic testing process we've been involved, years of collecting raw data to develop a hydrogeologic model that explains how we think the fluids will flow in the ore body. And the breakthrough times that we were able to verify with the tracer confirmed the assumptions and the outputs of our hydrogeologic model, which was fantastic. And the last part of this was cleanup. Again, using that tracer, we were then able to stop injecting tracer and enter a reclamation or cleanup phase for this test pattern, where all we did was keep pumping out instead of injecting in. And within 8 days, we were down in some areas to as much as 95% of the tracer removed from the pattern. And so that was all critical information that is added to the robustness of our test work over the last 3 years and helped us make the decision to advance into the formal feasibility study stage for the project.
David, I now want to ask you a question about valuation. A lot of your comps have taken out the highs that we saw in November of 2021, but Denison hasn't yet, even though your stock is up 20% on the year. But do you feel the market is fairly valuing Denison, or do you think you're being penalized because of this new mining method that's being used in the basin?
Jimmy, the valuations, they certainly ebb and flow. There have been periods of time where Denison has outperformed, and there have been periods of time where we've lagged a little bit. What we're focusing on right now from a valuation standpoint is driving home that our story is more than just Phoenix. It's natural that we would spend most of our time talking about Phoenix and the investors would be focused on Phoenix because it is our next source, and the primary source of production for this company. But what we're focused on now is bringing to light the other assets, like our Griffin deposit, like our assets that we have together with Orano, like Midwest and McLean, places where the valuation, I think, is underappreciated because these have been assets that have been basically on the shelf or considered to have minimal value through a number of tough years that people sometimes forget we own. And as the market has improved so significantly, these assets all of a sudden are actually potentially quite profitable. So look, we think there's definitely room on our valuation, and we'll be out there making sure folks understand the value of our actual portfolio of assets rather than just anchoring their valuations simply on Phoenix.
So I'm glad you brought up Orano and the assets that you own in conjunction with them. So why don't we talk about, first of all, why don't we talk about the McLean Lake Mill? You own 22.5% of it. Orano owns the balance, but this asset is very strategic and very important to the basin. And why don't you just tell us why?
Yeah, Jimmy, look, the most important thing is it exists. It's already been built. I like to joke that we could show, but I'm also truthful about this, that we could show receipts for about $1 billion of capex that have gone into this facility. It's no small task to build, let alone license a processing facility in the Athabasca Basin region for uranium. And this mill is, producing somewhere in the range of 10 to 12% of world uranium production at these sort of modern current levels. It handles high-grade ore without dilution, which is its unique characteristic, designed to handle the high-grade ore without having to add in waste. And it really does have now the potential to be a regional processing center, which is really relevant to the development assets we have with Orano. Now, from a regional processing center standpoint, there's two key elements. It's licensed for 10 years, starting in 2017. It's been licensed before, but that's an extra long license period from our regulators, the CNSC. It means we have clear visibility to it well into the second half of this decade. And most recently, we had our operating license amended to allow for us to proceed with a significant expansion of the tailings management facility. Now, that is really important for the longevity of this facility because it gives us so much more runway now in terms of what we can actually feed to the mill and where we'll put the tails that come from it. The mill is operating right now, processing Cigar Lake ores under a toll milling agreement. But as we've heard from Cameco recently, Cigar Lake production is expected to dial down slightly as part of their plan to bring back McArthur River. And that means that the mill is looking like it's going to have as much as 9 million pounds a year in excess license capacity right now. That is where it's driven home as strategic because it's about an improved market and looking at which assets can actually fill that 9 million pounds in the foreseeable future. And the assets that come to mind for me are McLean Lake, where we have unmined deposits with Orano, same joint venture as the mill, Midwest, which is also a joint venture with Orano, very close by, Denison's Waterbury property, where we have the THT deposit, ready to be advanced as an ISR project that'll feed that mill, and then also Denison's Griffin deposit, which is conventional underground mining at Wheeler, where we'd love to be able to truck that ore up to McLean Lake for processing and avoid having to build our own mill at Wheeler River or down in the southeastern part of the basin. It's just an example of the kind of things that the mill can now facilitate with improved market fundamentals.
So let's move on. I want to talk about one more asset, and then we're going to move on and discuss your balance sheet. But the Waterbury project, it has a preliminary economic assessment done on it. Why don't you just give us a brief overview of this asset and what's going on there?
Waterbury is a really interesting property. It's quite large, a lot of exploration potential, but most people know it because of our Teheldeth-Tway or THT deposit. Now, this used to be called the J-Zone deposit. It's known to sort of be the western extent of Rio Tinto's Rough Rider deposit. We reimagined this project about 2 years ago, given all the work that we had done on ISR mining. And we put together a PEA that showed that despite the fact THT is relatively small, 10 to 12 million pounds, 2% range, and in a tough geologic setting, again, in that sandstone at the unconformity, not the kind of place you'd want to do underground mining. But bringing ISR mining to it, we're able to show that this small deposit actually had great potential, generated some very robust economics, good IRRs, strong all-in costs, under $25 US per pound. And I think the study there really almost had more potential for demonstrating the power of ISR than what we've done at Phoenix. Phoenix is, 70 million pounds, 19%. You compare that with the low-cost mining method, and it makes sense that it's going to be one of the best mines in the world. But when you take THT, which otherwise would have been considered, very difficult to advance economically in the basin with conventional mining, and now it's in the bottom cost quartile of the industry, by pairing that deposit up with ISR mining, tells you that really the potential, if we find a 20 million pound deposit, another 15 million pound deposit, 30, 40 million pound deposit, in proximity to a mill or an existing facility with ISR, those have the potential to be leading projects, whereas conventional thinking in years past is that you needed monsters. You needed 300, 400 million pounds to be able to make money. And I really think THT drives home that what we're doing with ISR has the potential to really change the landscape.
David, I want to move on now and discuss your balance sheet. There's a lot going on here. You currently have over $60 million in cash, $200 million of working capital, and a big part of that working capital is your investment in physical uranium, 2.5 million pounds. Why don't you give us a little bit of background on that? Why did you acquire this? And maybe you can also tell us at what price and what it's worth now.
Yeah, Jimmy, it was such an interesting story. The market a year ago was just waking up to climate change, clean energy transition, and what the uranium miners might be able to do in terms of providing exposure to that narrative. We financed ourselves to the place where we were at a decent position to be able to fund our work through environmental assessment and feasibility study for the next several years at Wheeler River. And we learned that the capital markets were still very interested in investing in uranium sector stories. And the appetite was just immense. We saw many deals multiple times oversubscribed. And we asked ourselves whether it would make sense to go back and raise more money with the potential to really start de-risking the financial side of advancing Phoenix and Wheeler River. Our reservation was that we'd have to be picking that share price on that day and say, well, this is the right price to raise, a third of our project capex. And we didn't like that because, look, we had so much more to de-risk. We had a view that the uranium price would rise. At the time, it was under $30 a pound. And so we devised a strategy where we would raise the money to take advantage of the fact that the investor interest was there, the depth was there to access such a large amount of capital. But we put the money to work and we bought physical uranium instead of just parking it on the balance sheet as cash. Now, some people would say this is speculative. It was not speculative. We played through what would happen if the price went up, if the price went down, and we were happy with the valuation we'd be raising at to be able to buy uranium at the price that was available. Now, we ended up securing 2.5 million pounds at a price of under $30 per pound on average. And we've taken delivery of all of that. Market has moved. So by the end of the year, that uranium was up $41 million with the spot price of $42 at the end of 2021. Now, you flash forward to today, we're talking spot price in the $55, $60 range. And all of a sudden, the value of this material is up almost 100%, with a market value in the range of 180, $190 million Canadian. Now, put that back in context where we started. When we raised that money, we were looking to de-risk Phoenix by having about a third of the capex on the balance sheet in physical uranium. Now we're talking almost 2/3 of the capex of Phoenix in physical uranium on the balance sheet. Now, that's gone exceptionally well, but the purpose of it still is to hold it for the long run, to be able to make use of it as a project financing lever, to de-risk our ability to access project credit or other arrangements to fund Phoenix. It's a really different sort of scenario than most new projects or developers would be faced with. When you have on your balance sheet a saleable asset that's worth 2/3 or half or whatever it will be of your capex, when you're walking around looking for that support from the financial community to build your project, they're not used to seeing that kind of collateral on the balance sheet. And it does open things up beyond that too. Maybe it's talking to utilities for that capital rather than the traditional lenders to say, look, is there the potential for a prepay or something like that on an offtake where we can de-risk that offtake for you by having 2.5 million pounds already on the balance sheet. That makes this a little less riskier for the utilities. So that's the roundabout story, and it's gone fantastic for us. I think it's exceeded our expectations, but really has also done what we intended it to do, which was allow us to be dynamic to the market instead of just having that static cash sitting there.
So you acquired it for under $30 a pound. It's effectively doubled. If Sprott or Yellowcake phoned you up tomorrow, would you sell it to them?
Jimmy, we wouldn't. Right now, we're sticking to our strategy. I wouldn't say that there's no price where we wouldn't sell at, but at this stage, we're really happy with the way it's worked to basically create a floating financing for us that allows us to continue to see what the market delivers and allows us to give that dynamic performance to our shareholders from that holding. And the prize really still is funding Phoenix. And right now, we like holding the physical uranium as the way to continue to have that leverage to potentially even further improvements in this market.
David, one of the other elements that occurred in 2021 was the implementation of an at-the-market equity offering, or an ATM, which is a very efficient way for raising capital for a firm like Denison. But maybe you can tell us how active you've been with this ATM.
Jimmy, we're really happy with the way the ATM has gone. We have not been particularly active. We can really be very selective. I think it's critical that people understand that this ATM is discretionary. We do not have to use it, and so we use it when it makes sense to use it. We have a robust balance sheet to start with, and so we're really able to be in the market when it makes sense to be in the market. And that means when we're not going to have market impact, when there's significant liquidity, where the valuations are positive. And not only is the ATM a low-cost way to raise capital in that we pay the brokers far less, we issue the stock at the market rather than at a discounted basis with a warrant or anything on it. None of that happens in the ATM. We're able to sell into the market. But when you think about the cost, we're also able to pick our times in the market. And so we don't have to find the windows in the market where you can shove through $50 million. Because, you know, something about investors is that they're smart. They don't always love the idea of putting $50 million into your company when you've just hit a peak or something like that. And so we're able to average in to different price levels, very stealth, minimal market impact, but really there's even more than just the cost savings and the way that you can access the market at the prices you can. And that's something that we've been really happy with. And again, we're very cautious on it because we don't need the money. We have a robust balance sheet and we're trying to make sure that it stays robust by using the ATM selectively.
David, as we wrap up, what can investors expect in terms of news flow in the coming weeks and months from Denison Mines?
Well, Jimmy, it's going to be a steady diet of news around Wheeler River. That feasibility field test we've planned for 2022, I would expect multiple updates on our progress on that front. Definitely also on the environmental assessment side of Phoenix and Wheeler River. We are targeting submission of our environmental impact statement draft this year, which will be notable. And also, we will keep up on the exploration side of things on our project portfolio, looking for that next discovery. And as we touched on earlier, we've got some internal work that we'll be focusing on looking at Midwest McLean and understanding their potential for development in the nearer future. So lots of stuff on the go. Should be another exciting year for Denison.
David, that's a great overview and an update on Denison Mines, and I want to thank you for spending time with us today.
Hey, Jimmy, my pleasure. Thanks for having us.
Hi, Tim. Thank you very much for joining us today. How are things in Saskatoon?
Yeah, thanks, Jimmy. No, it's great to be with you again. Yeah, Saskatoon's great. I mean, you can see we got a sunny day here, and yesterday it was snowing. So, anytime we've got sunny, warm weather, we're happy here.
Spring is in the air.
Yep.
Tim, ISO Energy is located in the Athabasca Basin, which is the heart of the uranium industry, not only in Canada, but in the world. And before we discuss ISO Energy, I want to get your thoughts on how the current geopolitical situation is impacting those operators in the basin.
Yeah, I mean, there's been a lot of things going on. Obviously, as you know, certainly even leading into this year, supply demand fundamentals in the uranium industry have been changing significantly. You see it with, the price of uranium, which is now, closing in on $60 a pound. But yeah, this year started with, we had a little bit of, some civil unrest in Kazakhstan, which, thankfully was resolved very quickly. And, Kazatomprom's done a great job keeping everything, going very stably out of Kazakhstan. But then, of course, the horrendous events in Russia, obviously, something that, nobody wants to see, and certainly is impacting all sorts of things across the world, but also in the uranium sector. There's a lot of uranium still coming from Russia into the United States and into Western Europe, but in the United States, it's still providing almost 20% of uranium product into the U.S. utilities. So, there was already a lot of stress in the market. We've over the last few years, I mean, production is significantly below where requirements are. There's been, maybe 60 plus million pounds of drawdown on inventories and secondary supplies over the last few years. And I just read some UxC numbers, one of the leading consultants in our industry. They expect, another 66 million pounds of inventories are needed just to satisfy, year-to-year requirements this year. So, there's potential there for Russia to not be supplying into the U.S. market either soon, but certainly in the long term, it's going to have a lot of impact. And putting that additional, stress on the near-term and longer-term supply side is really going to have a lot of impact on the market. Obviously, that's, going to impact not just, the near-term supply side, but, for on the geopolitical side, as you mentioned, just to get back to that, I mean, there's going to be more and more interest, I think, more demand for production for projects out of very stable geopolitical, areas such as Canada, certainly U.S., Australia as well. But certainly, I think people are going to be looking more and more to the Athabasca Basin and the stability we have here in Canada.
Interesting comments. Thank you. Let's move on now and discuss ISO Energy and begin with a brief overview of the company for those investors who might not be familiar with the company.
Yeah, thanks. So, I mean, for those that don't know ISO Energy, we haven't really been around that long. We were formed in 2016. We were a spin out of NexGen. So at that time, NexGen put in 5 Eastern Athabasca properties. It was at a time when really, if you think back, it was probably the low point in the market. So not a lot of going on, kind of classic good timing for corporate development activities. There was a lot of properties to pick up. We now have 24 high quality properties in the Eastern Athabasca Basin. Today, as you mentioned, a lot more activity, yeah, and there's nothing available. So they got in at a great time. Our flagship project is the Rock East property, which is home to our Hurricane deposit that we found. We hit initial mineralization back in 2018 in the summer after picking that property up that summer from Cameco, and since then we've really been focusing a lot of time and attention on that deposit, which has developed into one of the the only new high grade deposit over the last few years.
And just clarify that for me. When you talk about high grade, can you just quantify that?
Yeah, I mean, so people that know the Athabasca Basin, you often hear like, the grades in the basin are 100 times the world average. And so for the really great deposits up there, the McArthur River, Cigar Lakes, now the ones being developed like NexGen's Arrow, we're talking about incredibly high grades. So this deposit, the Hurricane deposit, some of our best core to date. We had some in 2020 that was 3.5 meters at over 70%, 74% uranium. So almost pure pitch blende. If you see the pictures, it's it's just pure black uranium in that core. And even this summer, we kind of developed a new lens to the south of the main part of the deposit. We had one drill hole that was about 6.5 meters at over 20% uranium. So incredibly high grades when you think of other parts of the world that are mining at 0.1% uranium or lower.
And Tim, when you say 70% uranium, how would that compare to Cigar or McArthur?
Yeah, I mean, it's on par for grades. I mean, Cigar and McArthur are incredible deposits, several 100 million pounds of resource there. So I'm not saying that, necessarily Hurricane is that big size-wise, but on a grade perspective, it's right there. If you go up to McArthur, they will get, 50, 60, 70% uranium coming out of that mine in places. Their averages, I think, for Cigar these days are, maybe around 20% is the average grade or around there. But yeah, it's exactly what you want to see if you're looking for a unconformity hosted deposit in the Athabasca Basin and you start to get grades in that range. You don't need to find a very big deposit from a land perspective or a volume perspective to have something that's very significant.
And one other element that's very important about where you're located in the basin is the depth, right? Because of course, the deeper it is, then the higher your extraction costs are going to be, right? So why don't we just touch on that, and what would be the depth at Hurricane? Yeah,
so you're right. I mean, you need to make sure that when you do find something, it's in a reasonable depth that can be mined, like you said, economically. Yeah, Hurricane's at a very reasonable depth. It's just over 300 meters, 325, 330 meters from surface, right at the unconformity. So for example, McArthur, Cigar Lake are deeper. Phoenix is kind of a very similar deposit that's being developed by Denison, and it's even a little bit deeper than Hurricane. So from a depth perspective, that is not something that it puts up a lot of barriers in the future.
So let's move on. You commenced the winter drilling program in January, and you've been spending some time, of course, at the Hurricane Zone. Why don't we just start talking about that, and how many rigs do you have going, and how many meters are you going to drill?
Yeah, that's right. So we actually finished our summer program only at the beginning of November. So it was a late program, and then we got right back up for our winter drilling program in January, as you said. We plan to do just under 12,000 meters. Just about 2,400 of that was planned around Hurricane to test out some of the drilling that we'd done in the summer and some of the results that we found there that were interesting. So a little bit more at Hurricane to really our plan there over the last year has been to do some step out drilling to find sort of the borders of that deposit. So about 2,400 there, and then the remaining drilling is all going on at the Rock East out to the east of the deposit. So there's really about 15 kilometers of conductor out to the east. We did some geophysics, some ground geophysics in the summer out to the very far eastern edge of that property to help us find some good targets for this winter. And so that's really been our focus over the period. So yeah, the team's been up there. They've endured some incredibly, harsh conditions. It's really, a testament to, the team we have in place, that they've done the work that we needed them to do through those conditions, and actually we'll be wrapping up there over the next number of days.
So give us a little bit of background on that. When you say harsh conditions, what exactly do you mean?
Yeah, I mean, they've just had real long tranches of 40, 40 below, minus 40 degrees below 0 Celsius. Lots of snow. There's been lots of snow this year, and just really tough conditions. When you get into those temperatures, it's hard to keep fuel working properly, and in machinery continuing to work. It's hard to keep tents. These folks are they've got a great camp there, but they're tense, and so you need your stoves working, all that stuff. And yeah, when you get into those temperatures, it becomes a challenge. So it's really, like I said, a testament to their dedication and the work they're doing to get some drilling done in those conditions.
And where else have you been focusing your attention during this winter drilling campaign?
Yeah, so all of our drilling's gone on at the Rock East for the summer, or for the winter. We've also been doing some geophysics. So we did some drilling on Geiger this summer, which is the first time we've done drilling off of the Rock East in the last couple of years. Before we bought the Rock East and found Hurricane, Geiger was one of our top prospects. So we got there, did some drilling. We've been following up this winter with some ground geophysics to find some new targets, some areas, some alterations we discovered in our summer program. We wanted to do the proper assessment to find the right targets for future drilling. And we're also doing some ground geophysics this winter at our Hawk and Ranger projects to identify targets for future drilling programs there as well.
And when will the winter drilling campaign finish up?
Yeah, we should, our guys are actually, they'll be done probably by next week. They're actually, the drilling is done right now. They're just kind of cleaning up camp, and they'll be out of there next week. So yeah, we're planning to get initial results anyways, out to the market soon. And then of course we'll wait and get our official assays out as soon as they're ready from the lab.
And I'm sure those drillers are happy that spring is just around the corner.
Yeah, well, sure. Yeah, they are. I mean, spring brings with it its own challenges up there. Everything starts to thaw, and it becomes tougher to move stuff around. But yeah, they're definitely happy when the weather changed. That's for sure.
So to that point, when would your summer campaign begin?
Yeah, we'll probably be getting back up there in the June, July period. We'll take some time to assess the results from this campaign, look at the geophysics work that we've done. We also did some additional geophysics on the rock, or on Geiger. I think I mentioned that. So yeah, coming out of those results, we'll determine where we want to spend our time and energy this summer. And yeah, and that'll be going on over the next several weeks, and yeah, we'll be back up there, in short order.
Tim, one other point I want to bring up before we move on, but the hurricane zone borders on a property which is owned by Cameco and Orano. Have they done any work on that in this past year?
Yeah, so yeah, it's a really interesting question, Jimmy. They, obviously we've had a lot of success, and you're right. If you look at a map, we are right, the heart of Hurricane is right on the border of that deposit. So, I always say, like, it doesn't take a geologist to realize that there's probably something on the other side. Over the last year, Cameco, I'd say, has started to show more interest. This past summer, they did some geophysics on the other side of the property, and we understand they have about a 5,000 meter program that was planned for this winter on that side. So that's, to us, that's really exciting, because, in the absence of us having access to it, which would obviously have been our preference, it's good to know what the whole project looks like, because Hurricane on its own is a great deposit. But, as you start to move to the next step of technical reports and looking at feasibility, does this thing make sense as a project? It obviously makes a lot more sense if you have the whole picture and potentially even a bigger deposit.
So as you mentioned earlier, you do have 24 properties. We touched on 2 of them. Is there another 1 or 2 properties that you would like to target going forward for the summer program?
Yeah, so like I mentioned, we're doing some more geophysics on Geiger that we drilled last summer. So we'll look at doing some work there. Last summer we also did some work, some airborne geophysics on a property called Collins Bay Extension. We like that property a lot. It's right on trend of past mines, including the Eagle Point mine. So we like that a lot. We'll give that some consideration. And yeah, there's a few other projects. Like I said, we're doing some geophysics on Hawk and Ranger, and yeah, over the next month or so, we'll determine exactly where we want to be setting up our drills.
Tim, let's move on now and discuss your balance sheet. Cash is the lifeblood of an explorer co. So how much cash do you have?
Yeah, we are sitting right now on about $11 million. With obviously drilling bills going out the door, it's changing quite a bit. But we started the year with over 12 million, so we have enough money in the bank in cash to get us through our plans for drilling this winter and this summer. But yeah, obviously we keep a very close watch on it, and the market has been very supportive these days. There seems to be access to sufficient capital to keep programs going, and so yeah, when the time is right, we'll look at going to the market and raising more money as needed.
It always helps when the underlying commodity is up 25 or 30%.
Yeah, it does. It's amazing. The phone starts ringing a lot more as soon as the price had fallen off a little bit before Christmas, and then it started to rally again this year, and yeah, the phone starts ringing again pretty quick. And I can tell you there's a lot of people, it's not just the fact that the uranium price has gone up, it's the fact that there's a lot more talk in the industry and the world about how important nuclear is becoming for to address climate change issues. And certainly even with what's going on in Russia, there's more and more talk about energy security and those folks that need baseload energy, and you don't want to be reliant on other sources of oil and gas. They're now talking more and more about nuclear. One of the best stories I think is France, where a couple of years ago they were looking at still supporting nuclear in a big way, but also maybe kind of paring back their reliance on nuclear. And now I think that's shifted, where you just had announcement from Macron where he's saying we're going to build another 6 new plants. We may build up to 12. You've got countries like Poland, you've got countries all over the world that are even the German situation, where it was hard as someone in the nuclear industry to understand how they could make the decisions they do to shut down plants. Even some of that's being reviewed. Belgium was going to shut down some plants. They've just made decisions to continue operating those for a number of years. So really those kinds of things are really showing that the nuclear story is getting out there, and it's causing a lot of people that maybe hadn't focused on the industry before to be very interested. And so that's bringing, I think a lot of companies say, capital that we hadn't seen before. There's always been a lot of very nuclear supportive funds and others that are willing to support it, but there's a lot of generalists now that are coming in. We're seeing, and that's really exciting for a company like ISO and for the entire industry.
Tim, let's discuss your shareholder base. As you mentioned at the onset, your largest shareholder is NexGen. How much did you say they own?
Yeah, so NexGen is, of course, an incredibly important shareholder to us. They're still over 51%. So, I always say, it's the other benefit that ISO has, to have such a supportive shareholder, someone that's in the industry, knows it, and loves this industry. So yeah, we're really fortunate, because not only do they provide good backup on the financial side, but they're supportive from an administrative, from a strategic sense as well. And yeah, we're very closely aligned and work closely. And aside from that, we've got a few good strategic, I'd say institutional shareholders that love the industry and love the sector, and then it seems to be a very supportive retail contingent as well.
Tim, I want to ask you one more question before we wrap it up. You worked at the world's second largest uranium producer, Cameco, for over 20 years, and you also worked at Denison, a very large developer, and now you're at ISO Energy, which is a much smaller Explorco. But can you just tell us or summarize what exactly it was about ISO Energy that drew you to the company?
Yeah, when I got the opportunity to join ISO, frankly, it was just one of those things you couldn't say no to. ISO really is in a very special category as a company that has a new high grade deposit. There's no one else on the planet over the last few years that's found something like ISO Energy has. So to be given a chance to lead a company at this stage, I believed in uranium from the get-go, even though I wasn't ready to tell you exactly when things would turn. I knew it would, or at least I believed it would, and so it was a great time to come on. Like I said, great support from a company like NexGen is important too, because it puts ISO also into a very unique category where it's got that kind of support behind it. So yeah, it's a stretch for me too. It's just, at this point in my career, something where I'm able to, go into a company like ISO. I'm learning a lot every day. It's like an MBA class every day, working, at ISO and leading this company. So yeah, like I said, I just couldn't say no to the opportunity. It was just something I knew I'd regret if I didn't give it a try.
Tim, as we wrap up, what can investors expect in terms of news flow in the coming months from ISO Energy?
Yeah, so, like I mentioned before, we are just finishing up our winter program. We'll have some initial results out, very shortly on that as we finish up at the site. We've got, that core going into our lab here in Saskatoon at the SRC, Saskatchewan Research Council. So when the assays come out, that'll be, it was a little delayed last year. We'll hopefully get those out sooner. I know SRC is trying to work to a tighter schedule, so we'll get that out within the next few months. We'll certainly be looking ahead to the summer program, what we're going to be doing, and put out new results there. Just maybe one point I'll just mention, one press release we just had recently, we just hired a new chief financial officer. For me, that's huge. It's a gent, Graham DePries, who has a ton of mining experience, decades of mining experience, and even 6 or 7 years in the uranium sector in the past. And so we were able to convince him to move from Toronto with his family here to Saskatoon, and so he'll be a full-time CFO. And I think as we grow and continue on this path, getting quality people is also incredibly important for us. So I think that just it's worth noting, because it just I think you can't underestimate the value of good people in your organization.
So true. Well, listen, Tim, thank you very much for spending time with us today and providing a great overview of ISO Energy. And to all of our viewers, if you have any further questions for Tim and his team, or if you would like some research on ISO Energy, send us an email to info@bloorstreetcapital.com and we will send that along. Tim, once again, thank you.
Yeah, Jimmy, it's always a pleasure. Thanks a lot for having me.
Hi, Leigh. Thank you very much for joining us today. How are things in Australia?
Yeah, they're good. Thanks, Jimmy. With the skies opening up again, with the lax in measures around the COVID-19 policies and procedures, it's been great to get out and see all of our shareholders. I haven't gotten around to all of them yet, but with the listing on the ASX that we initiated back in July 2021, I've taken the opportunity to come down and see some of our existing shareholders and potentially new ones. And look, it really is great to see people in person again. The other week we were at the BMO conference in Miami, which was the first time in over 2 years, and And I think everyone's feeling it's great to be back in person. Having said that, we're still going to be utilising Zoom a lot with respect to investor calls, and we look forward to continuing that dialogue as well. But yeah, with the demand down in Australia for nuclear energy, the investor demand, it has been a fantastic reception that NexGen's received over the past couple of weeks.
Well, that's good to hear. Leigh, we have a lot to discuss in a short period of time. So why don't we just start with a brief overview of NexGen Energy? Where are you based and what stage of development are you in?
Yeah, NexGen Energy is a Canadian-based development company. We are in the process of the completing our EIS, our environmental impact study, for the Rook I project. Rook I is located in the western side of the Athabasca Basin in northern Saskatchewan. And the project economics, as we'll discuss in this interview, make it one of the leading mineral resource projects globally, not just in uranium, but across all commodities when you consider its economic value per tonne.
Leigh, the big milestone you and your team reached in 2021 was the release of the feasibility study. And I want to start here because it really encapsulates how unique and how special this asset is. So why don't you just start with a brief overview of that feasibility study, what the CapEx is, the net present value, the internal rate of return, and also the payback.
Yes, Jimmy, as you said, it is a phenomenal project, and the feasibility study really did highlight not just the economic attributes of this project, which make it world-class, but also the environmental performance as well. Two very key aspects that NexGen's focused on, both the economics and the environmental and the community aspects associated with developing a project of this nature. Given its extraordinary quality, it deserves the very, very best. And myself and the team at NexGen Energy are completely dedicated to optimizing this opportunity economically, environmentally, and socially as well. Highlighting the environmental aspects of it, it'll have an incredibly small footprint, even though it'll be producing approximately 25% of the world's production in the middle part of this decade. Some of the economic consequences of that is it's at a $50 uranium price that I'm quoting these prices. We're currently at $59. So these are a little out of date, or they're greater, but at a $50 uranium price, it's got an after-tax NPV of about $3.5 billion, incorporating an 8% discount rate. That gives it a payback of about 10 months over the first period of production, and an internal rate of return of 52.4%. Look, when I was in private equity looking at resource projects right around the world, there wasn't a project that had this type of economic attributes. Put on top of that, its sovereign location of being in Saskatchewan, ranked the #1 mining jurisdiction in the world, and with its environmental performance, it's going to have an extraordinarily low footprint. We're basically extracting the volume of one double-decker bus a day. And so whilst it's going to be producing or be the world's largest uranium mine, it's in terms of pounds produced, it's actually physically going to be one of the smallest mines globally, which is a fantastic attribute to it. CapEx, $1.3 billion, as I said, at a $50 uranium price. That payback period is about 11 months. At $60, it's less. So the project lends itself to really advantageous financing structures. It can sustain a large proportion of project debt, and given that those economics and the fast payback period. The average rate of production in the first 5 years will just be a shade under 30 million pounds. And over the first 11 years, it'll average around 22 million pounds per annum. But importantly, I want everyone to note that the feasibility study is only incorporating the measured and indicated resources. We have another 80 million pounds in inferred resource. And we also have significant areas of mineralization and drill intercepts that isn't actually in the resource statement at the moment. We're already dealing with what is the world's largest project under development. We will follow up that mineralization in due course, and we've got 2 drill rigs that will be drilling this year in the background as we are commencing construction. But it's suffice to say, this is a multi-decade project, and we're applying for an initial mine life of 24 years.
That's a great overview of the feasibility study. Now I want to move on and talk about the environmental impact statement, or the EIS, and this is the next big permit that you're moving toward, and it's being delayed for a few months now beyond circumstances beyond your control. And I just want to provide a little bit of clarification on this and why it's been delayed. It's a very complex and detailed report. It doesn't happen in months. It takes many years to complete this. So maybe you can just give us a little bit of background on this. Why is it taking so long, in the importance of this document?
Yeah, I wouldn't really describe it as being delayed. Look, this is a 20,000 plus page document, and all the information's there. It's the aggregation of over 9 years of work, and compiling that across the technical, environmental, and social aspects of the project. It results in about a 20,000 plus page document. And as with everything we do at NexGen, we are aiming to have this as the best EIS that's ever been submitted. And as a consequence, we're putting a lot of work into the navigation of a 20,000 page document. So not just the regulators, but also the public and everyone who is interested can fully and transparently review the document in an efficient manner. And so we're putting a lot of effort into that, but we're only weeks away from the submission as we speak. And as you can imagine, with such an objective and the volume of data and the studies that have been done, it does take we've been working for the last 6 months on just basically bringing that all together in a succinct fashion. The upside of that is it'll mean that the review, as I said, be it from a regulator or anyone or member of the public or community who'd like to look at it, will be very efficient and transparent. So I think ultimately it's in the interest of everyone that document, even though it may have been delayed, as you said, for a period of time, the work's been ongoing, and it's really just reflected our commitment to everyone who reads it, that it's in the best form possible. And so it's a significant milestone for the company. We're very, very proud of it. And it really is a very significant year for NexGen in 2022. We're going from defining the project, which the EIS does in every aspect, to then constructing the project. And that's going to be started with some early site preparation works in terms of expanding the accommodation camp in readiness for the construction crew, some widening of roads into the project, an airstrip, and some other preparations for sinking of the exhaust and production shaft. And so everyone at NexGen, incredibly excited, very, very focused on the completion of this EIS. We're very much looking forward to the review process. I know there's been a lot of comments by other industry participants about how long it does take to review an EIS, but we're very much looking forward to it, and very, very extremely confident that we're going to set another new standard, elite standard, with it when it comes to the submission of the EIS, the review time, and the quality and transparency of that EIS is going to be second to none.
And just give us the timeline. So once you submit this to the government, how long will it be before you receive a?
Yeah, there's a period of review by the government to make sure it's in concordance. On acceptance of that, a 90-day public comment period commences. At the end of that 90-day public comment period, all questions that are relevant and validated are addressed, and then the EIS becomes final, followed by the commission hearings by the CNSC.
Once you deliver the EIS to the government, and you're going to be waiting on a decision, but then you're going to have to think about financing. And given that this project is going to be spinning off $1 billion a year in cash flow, you're going to have a lot of options available to you. But maybe we can just discuss some of those options in terms of financing, how well you finance that $1.3 billion CapEx.
Yes, Travis and myself have been working on it for quite some time. There's a number of options available to us with respect to financing this project. It can be debt, equity, or even advance payment on future production. Suffice to say, given the economic strength of the project, its environmental footprint, and also its social consequence, we have many institutions lining up to finance this exciting project. I think what you'll see, though, in when we do complete the financing package, and it could be in stages, most likely will be in stages, is that you're going to see a financing package that's highly unique, similar to the CEF financings that we did back in 2016, 2017. They were very unique in the sense that they were fit for purpose for a project like the Rook I project. And I think the financing package of the Rook I project to finance construction will be very similar. We have some fantastic attributes which opens up additional avenues in providing financial flexibility. And NexGen has demonstrated ever since the inception that we've always done incredibly strong financings in the context of the market. And that is a reflection of not only the quality of the asset, but our experience on the financing side of the industry. And some important components which we are going to incorporate into that financing package is we're going to ensure that the project maintains leverage to future prices. And we are not going to look to hedge significant amounts of production in order just to get the debt financing package. All of the work that we've done to date suggests that we don't need to do a significant amount of hedging with respect to the production in order to secure a large proportion of debt. So in summary, this package is going to be optimized. It's going to reflect the high quality nature and unique nature of the asset. The ESG footprint or profile of NexGen and the Rook I project is elite, and that's also attracting new avenues of capital which want to be involved with the project. Incredibly exciting. A lot of people have said 1.3 billion, that's a big ticker. Well, it's not really when you consider the economics of the project and also our experience in financing mining projects, not just whilst at NexGen, but previously. So we're very much looking forward to that at a time that we are commencing site works in 2022. And with the ongoing drilling. So incredibly exciting time. I just want to make the point, we currently have about $190 million in the treasury. We're well financed into the end of 2023 with all of our permitting and site infrastructure programs that we have in front of us. So the timing of such financing is in that somewhere in the future.
So we had a good discussion on the feasibility study and also the EIS, and now I want to move on and talk about exploration, because this is where I see the real upside, because you've only explored a very small percent of your overall land package. And you've said before, you did start a exploration program last year. And I think during the last discussion, you made the point of you're not looking to expand Arrow, you're looking for another Arrow. So why don't you just tell us about your exploration program that you have planned, that's ongoing right now, but also planned for this coming year?
Yes, Jimmy, as you said, we're already developing what is the world's largest highest grade project into construction and production. We found it with the very first drill hole on that particular target within a 4.5 kilometre radius. There had not been a drill hole in the history of the project. And so, look, you know, our exploration team is obviously very, very skilled and talented. But to find the mother lode with the very first drill hole, yeah, it suggests that that there is additional mineralization on the Rook 1 tenement. We've only probably explored less than 2-3% of the entire Rook 1 property. Around 10% of the Patterson corridor that goes through the Rook 1 property. And so we've got an enormous amount of exploration in and around the western side of the Rook 1 project as we speak. And you've correctly pointed out, we aren't interested in just in expanding Arrow incrementally. What these two rigs are doing is looking for brand new Arrows. And we know they're there. They do take time to discover, even though Arrow, was relatively quick. These things are difficult to find, but we know we're in the best district in the world. Arrow validates that. We've got a whole plethora of targets that we're desperate to, or very much looking forward to drilling. Before we fully understand the full uranium endowment on the Rook 1 project, we often say it would take 10 rigs drilling full time for 10 years to really start to begin to understand the full uranium endowment on that Rook 1 property alone. And then we've got 2 additional packages along the western border of the Athabasca Basin in an area which I and others think is the new address for the world's uranium production.
And when can we expect results from your drilling campaign?
That will probably be at the end of the season during summer. Look, if we hit something which is material, we'll come out and say it immediately. No doubt about that. But we'll on the expectation that it's a successful program, we'll release the results at the end of that period. As I said, with the qualification, if we hit something very material, well, obviously we'll release that immediately. So no, it's very exciting to have 2 drill rigs in the background drilling away at these targets as we are developing, the very special Rook 1 project into construction.
Leigh, before I let you go, maybe you can just summarize what investors can expect in terms of news flow here in the coming months from NexGen Energy.
Yes, submission of the EIS will be a large one. We'll also have the exploration campaign, plus details around the site preparation work that we'll be undertaking in 2022. There's going to be an enormous amount of news flow, a lot higher news flow than what we've had in previous years. And this is all occurring at a time where the market is coming into a range which has been building for the last 10 years. It's not just as a result of the Sprott Uranium Trust buying pounds. They are doing a fantastic job in recognizing the shortage of uranium in the market and providing some proper price transparency, which is in the interest of all. And then with the importance of clean air energy being recognized by the UK, the European Union, the US, I see South Korea, the new Prime Minister is going to reintroduce nuclear power. Japan is looking at accelerating the restart of their reactors. In my 20 years in the uranium industry, I've never been involved with a public sentiment so positive about nuclear power. And for someone who's always been passionate about it, I've got to say, to see the world recognizing the science of nuclear power as opposed to the false ideology, and understanding if you want clean air environment, you need to have nuclear power now. And it's not just us saying it, Bill Gates is saying it, everyone's saying it. They're recognizing the science. It's incredibly pleasing to see. And to be a part of that clean air solution for the planet, as I said before, it's also one of the privileges I have as CEO of NexGen Energy and everyone at NexGen Energy. And that's why we take it so incredibly seriously and so committed to elite standards.
Well said. Well, Leigh, I want to thank you very much for spending time with us today and providing an update on the NexGen Energy story. And we look forward to the upcoming EIS and also the exploration results. And hopefully you and your team find another arrow.
Thank you very much, Jimmy. It's an absolute pleasure. And I look forward to speaking to you again.
Thank you. Hi, Andre. Thank you very much for joining us today. How are things in London?
Hi, Jimmy. Thank you for the opportunity to speak to your audience. Things in London are good. It's a lovely spring day here. You know, the spring flowers are out, and our COVID restrictions have basically gone. So it almost feels like life is back to normal.
Things are looking up finally.
Eventually, yes.
Andre, Yellowcake PLC allows investors to invest directly in physical uranium. In North America, investors are very familiar with this concept, but they're not familiar with Yellowcake. So why don't we just begin with a brief overview of Yellowcake? When was the firm founded? Where is it based? And what was the rationale for starting the firm?
Sure. So if we sort of rewind back to 2017, which is really when the work started in earnest to set up Yellowcake, there was a gentleman called Peter Backus who was previously at Morgan Stanley. He had a relationship with certain folk who had a relationship with Kazakhstan. Kazatomprom at that stage were looking to become more commercial. They were looking to stop selling in the spot market and stop selling to traders. And it sort of coincided with a time when we looked at the supply-demand fundamentals for uranium. And it was quite evident to us that the uranium price had to go up. I mean, if you look at the spot price at the time, it was below $20 a pound. And if you applied that price across the production portfolio, it seemed like a lot of people wouldn't make money at those sorts of prices, were it not for the long-term contracts that they had at much higher prices. So really, I've spent most of my life in the resources industry. Uranium's a commodity, commodities are cyclical, and we convinced ourselves that uranium was closer to the bottom of the cycle than the top of the cycle. So it was a fairly simple supply-demand fundamental analysis that persuaded us to go down this path. And also, uranium is not that easy a commodity to play in. It's not like gold or copper where individuals can easily own the physical. So we set about setting up Yellowcake. We IPO'd in 2018, July 2018. Took us a little longer to put all the plumbing in place than we thought. But when we IPO'd in 2018, we made our first purchase from Kazatomprom, and we purchased the material at $20.01. So, I think our thesis has played out. We still think there's a ways to go, but the uranium price now sort of nudging mid 50s towards 60 is quite a healthy increase from our first purchase. But again, that supply demand fundamental situation still applies today. We think, we haven't seen much new supply come to market. We see a much better demand environment. So, the thesis that held at the time of our IPO still holds today. So that's really some of the background on Yellowcake. We're a corporate vehicle. We're not a fund. We're listed on the London Stock Exchange, on the AIM market. We're Jersey registered. We have 2 employees, myself and the CFO. We don't have a permanent office, so we both work from home. So the whole structure is set up to be as cost effective and low cost as possible. We store our uranium principally in Canada, and we have some uranium in France. We set up a second storage account because it allowed us to take advantage of location swap opportunities. But most of our uranium is stored in the Cameco facility in Canada. We currently own physically 15.8 million pounds, but on a pro forma basis, we own 18.8 million pounds. We've got about 3 million pounds due from Kazatomprom in the next few months. So that will take us up to almost 19 million pounds of physical material.
And Andre, given that Yellowcake trades on the London Stock Exchange, are your shareholders mostly Europeans?
Well, it's interesting. We've had quite an interesting transition in our register. So when we IPO'd, we had a typical IPO register. A few people were in there to make a quick profit. But our register was basically 50% UK, about 25% North America, maybe a bit more, and the balance was principally middle, Asia and Australia. Last year we did 3 equity issuances, and we've seen our register transition. We had a lot of North American demand in the first equity issue that we did, which was in February, March last year. So today our share register would be 50% North America, about a third UK, and the balance, Asia Pac. And also, when we IPO'd, we didn't do a retail offering, and today we have about 22% retail shareholders, mainly in the UK. So interesting the way the register has transitioned. Certainly during 2020, 2021, we saw a lot of North American interest in uranium equities, and it's a commodity that the US and Canada understand pretty well.
And why did you decide to list in London and not Toronto or New York?
When we set up Yellowcake, there was another similar entity trading in Toronto called Uranium Participation Corporation, which now is sort of morphed into the Sprott vehicle. So they were TSX listed. We thought, well, let's tap into a different geography. London is not a bad resource market. It's a market that understands commodities. I'm based in the UK, so that was kind of our rationale, to provide a different jurisdiction, a different vehicle. Albeit it was a similar vehicle to UPC from an exposure point of view, but was listed in a different geography. And I must say, if you look at how our share register has transitioned, we don't think being London listed has been a hindrance on us raising capital effectively.
That's a great overview of Yellowcake, Andre. I want to move on now and discuss one primary advantage that Yellowcake has over its competitors, and that's your commercial relationship with the world's largest uranium producer, Kazatomprom. I'm very curious how this whole relationship started, but maybe you can provide a little bit of background on that and tell us the terms of that relationship.
Yeah, so as I touched on a little earlier, it was really, sort of good timing and good fortune where one individual sat on a board, that the other board members had a relationship with Kazatomprom at a time that they were looking to sort of change their marketing strategy. And, you know, they wanted to stop selling into the spot market, stop selling to traders. And, you know, we were an interesting vehicle to pick up those volumes. You know, we became an additional customer of theirs, and you know, a customer not too dissimilar from their other customers, in the sense that we would buy and hold uranium. We wouldn't trade it and put it back in the spot market. And also we wouldn't compete with their existing customer base. So that was kind of the genesis of it. The details of the contract, it's a 10-year framework agreement that was put in place in 2018. It allowed us to make the initial purchase of $170 million of uranium. And then we have 9 years of $100 million per annum. And it's essentially at the spot price. So that will run through to 2027. It's at our option, so we can do all of it or none of it. We can do it in multiple tranches. In 2019, we were only able to purchase about $30 million. Last year, we did almost $400 million. So it gave us a lot of flexibility. The way the pricing mechanism works, it takes the last two quoted weekly prices from Trade Tech and UXC. So it's essentially the spot price. We have a window through, you know, in which to finance the transaction at that held price. So it's you know, we think it's a very good advantage for us. In an oversupplied market, you know, when we were back in 2018 into 2019, I think the contract was interesting. But now that we've transitioned into an undersupplied market, I think, you know, we think that that contract has much more value for us.
So I want to get a better sense of how this process works with Kazatomprom. In December of 2021, you took delivery of 2 million pounds from Kazatomprom. Can you briefly explain this process? Do you phone them up and say, hey, I can buy $100 million worth of uranium right now, or is the process a lot more formal than that?
Yeah, it is a pretty formal and mechanistic process, and it works well. You know, we send them a note to purchase. They've got a defined period to come back to us. The price that's quoted is, as I said, it's the average of the 2 weekly prices. We've then got a 2-week window to finance the deal. You know, we finance it through raising equity. We confirm the purchase, and then we agree a delivery schedule depending on what their logistics looks like and what their you know, production program looks like. And the material is delivered to the Cameco facility in Canada. So what happens is they deliver to Canada. The Cameco facility accepts the product if it's quality controlled, you know, quality accepted. Once it's entered into their name, there's a book transfer into our name, and then we make payment. So, you know, we're not licensed to transport the uranium. We take delivery at the Cameco facility in Canada via book entry.
And what's the time frame associated with this whole process?
So, you know, the sort of notice period when we advise a purchase, you know, it's a few weeks, so it's not instantaneous. And then I said we've got you know, a couple of weeks to finance it. But it really, you know, if the markets aren't there or if we can't raise the equity, then we don't go ahead. And it's a private process. So, you know, if we send them a notice to purchase and the markets turn against us, which has happened, you know, we can kind of put that aside and send another notice to purchase. So it's a, you know, it's a good process. It works well with them. You know, as I said, because it's very mechanistic, there's you know, there's no judgment calls involved. It's a set process, and you know, I think it works well for both parties.
But how long does it take to actually take possession of the uranium?
So that really depends on you know, the material that Kazatomprom has available in inventory and what their production schedule looks like. So the last issuance we did in October last year, we're only going to get the material in June of this year, and I think, you know, that's evidence of the fact that Kazatomprom doesn't have a lot of inventory and the market's tight. So, you know, the very first purchase we made at the time of the IPO, we got the product pretty quickly. But as the markets tightened and you know, there's been pressure on producers, we've seen that that time horizon shift out a little bit. But it's yeah. So October we'll get the product in June, so a little over 6 months. And we only pay once we get delivery of the product. So we don't run credit risk, but both parties effectively have price risk.
In October of 2021, Kazatomprom announced an investment in a physical uranium fund called ANU Energy, which will hold physical uranium, very similar to what Yellowcake does. Has this or will this change your relationship with Kazatomprom?
I don't believe it will. This is something that has been spoken about for quite some time. In fact, it was, on the drawing board back at the time that we IPO'd. I suspect that Kazatomprom and the other investors have seen how successful Yellowcake has been, and the Sprott entity. There is certainly a lot of investor interest in uranium equities. When we came to market in February last year, we were looking to raise the $100 million, but our book was heavily oversubscribed. And within a 6-week period, $1 billion was raised in the uranium. And then Sprott came to market, and we've seen the success that they have had. So I think on the back of that, the ANU Energy Fund was set up. But as I said, it has been on the card for quite some time. I understand it's going to be a Kazakh vehicle. So, it's a domestic investment vehicle. We don't think it will compete in the same way. I don't really compete with Sprott. We're both buyers of commodities. We both provide access, to uranium exposure for investors. So, the more vehicles that get set up like this, I think it's a net positive for all of us.
Andre, can you also purchase uranium in the spot market? And if so, how much did you purchase in 2021?
Yeah, our arrangement with Kazatomprom is not exclusive. So last year we purchased just over 3 million pounds in the spot market from spot players. But what we've done is, even though we exercised the full option in February, March of last year, in June, when we were back at a premium to net asset value, we went to market to raise money, but we contacted Kazatomprom first and found out if they had any material. They did. And so we raised money around that, and then raised additional funds which we used in the spot market. And then again in October, we purchased 3 million pounds of uranium. Just under 1 million came from Kazatomprom, and the other 2 million pounds came from the spot market. So we tend to go to them to see if they've got inventory, even if we fully utilized our option. We have a very good relationship. But it's not exclusive in terms of us being able to go to the spot market.
Sprott has an ATM mechanism which has allowed it to grow very quickly in a short period of time. Can Yellowcake also adopt such a strategy?
Yeah, that is certainly something we've looked at. There isn't a company in the London Stock Market that has an ATM. It's quite tricky. We have looked at it. Because you would have to issue a prospectus every time you raise capital. It makes putting in place an ATM facility quite tricky. It's not impossible, but it's much more difficult here in this market for us.
Yellowcake is currently trading at a discount to net asset value. It's around 7 or 8% right now, but it was as high as 15%, which provides a great opportunity for value investors. But why is the discount so large?
Jimmy, that's a question that perplexes me. I guess in part, I don't know whether we, our association or our relationship with Kazatomprom means that people perhaps think our uranium stored in Kazakhstan, which it isn't. It's stored in the same facilities that Sprott stores its uranium. Also, the price tends to get quoted during our close, and Sprott trades, quite a lot of their trading happens after our market close. So the next day we tend to play catch up. But certainly at a 15% discount, it doesn't make any sense at all. Back in 2020, when we had the first wave of COVID, we got to a 30% discount, and all we held was uranium and cash. And at that time, the board took the decision to put in place a share buyback. And I think if these discounts persist, our board would certainly reconsider putting in place a share buyback, because if we can buy back our own stock at a 10 or 15% discount, we're essentially buying uranium at a 10 or 15% discount to the spot market, which would be attractive. So we have a little bit of surplus cash, and I think if these sorts of situations persist, our board wouldn't hesitate to consider that again.
And as you mentioned, your uranium is held in storage in Canada and France, which in the same location that Sprott holds theirs. You're on one side of the warehouse, Sprott's on the other side, but they can effectively buy your pounds significantly cheaper than they can buy Sprott's at this current time. Yeah,
I think for investors, us trading at a discount, as you say at the moment, 7-8%. That gap provides investors with an opportunity, because our philosophy or our strategy is basically to issue equity at a premium and buy uranium, or buy back stock at a discount. We won't issue stock at a discount, because that disadvantages and dilutes our existing shareholder base. But that's kind of the only trading per se we can do is look at where we trade to NAV, increase the uranium inventory at a premium to NAV, and buy back stock at a discount. And we saw through 2020, for a long period, we were at a discount to NAV. If you look at UPC's history, you'll see there are periods of maybe a year or 18 months where they traded at a discount to NAV. Even the Sprott vehicle in December traded at a discount to NAV for quite a period of time. So we will come back. It will come back, and I guess we have to be a little bit patient. But one has to look at the macro context. We've seen the Sprott vehicle come to market. We saw the Kazakh unrest in January. We've seen the tragic impacts around the Ukraine invasion. That's created a lot of volatility in the market generally, but also quite a lot of volatility around the uranium price. We see now in the US that one of the senators is talking about, or put forward a bill to ban all forms of uranium import into the US. So there's just a lot of uncertainty right now. So I guess if we do sort of bounce around the NAV discount for a little while, it's somewhat understandable. But I don't think we'll tolerate big discounts for any significant period of time.
So you just mentioned Russia and the Ukraine. Why don't we move on now and discuss what impact that is having on both the spot market and the term market? Yeah,
I think the fundamental driver of the uranium market really is the term market and the utilities. The utilities generally purchase about 85% of their needs in the term market, and a little bit in the spot market. And the spot market volumes have been driven by traders and the likes of ourselves and Sprott. So I think the geopolitics will probably drive the term market, because that's where the utilities need to think about how they're going to get the materials, security of supply, and all those sorts of things. The spot market, has been driven in a large part by Sprott buying and other sort of buying like ourselves. So I think it's getting really complicated. If you look at the Russian enrichment capacity, it's over 40% of global enrichment capacity. If you look back from say 2011 to 2020, the US imported about 26% of its needs through Russian enriched material. The EU over a similar period has imported about 33% of its needs. So to shut that off it will have a big impact, and we'll have to see how that plays out. Now the utilities have inventories, but it's kind of in the wrong form. It's in U3O8 or UF6, not in enriched material. Now again, there is a little bit of time, because refuelings tend to happen every 18 months to 2 years. So it's not like you run out of fuel tomorrow. But I think if enriched material was prohibited from being imported into the US. That's going to create a very, very interesting dynamic. And I don't know whether it creates a bifurcated market where, you know, the Russian material has to go find other homes, and you know, the US has to find other sources of enriched material. You know, you can build enrichment capacity, but I don't think you can do it overnight. You know, it'll take a little while to add enrichment capacity. So I think, you know, we really have to see how this thing plays out, and it's going to be very, very complicated.
Andre, as we wrap up, what can investors expect in terms of news flow from Yellowcake in the coming weeks and months?
Yeah. So, you know, we're a March year-end company. We'll be putting together our financial results for the full year and our annual report, but that'll be due out sort of later, sort of around the middle of the year. You know, for us, if we trade back at a premium to net asset value, I'd really, really like to be able to pull down our 2022 Kazatomprom option. But it's, you know, it really depends on where we trade. But you know, we'll have to wait and see how all of this plays out.
And what about a buyback?
Well, as I said, you know, if we keep sitting at these you know, discount levels, which don't make any sense at all, then I'm pretty sure our board would actively contemplate doing something.
Andre, thank you very much for spending time with us today and sharing the Yellowcake story. To all of our viewers, if you have any additional questions for the Yellowcake management team, please send us an email to info@bloorstreetcapital.com and we'll get an answer to your questions. Once again, Andre, thank you.
Thanks very much, Jimmy, and I enjoyed the chat.
Hi, Justin. Thank you very much for joining us today. How are things in Southern California?
Things are really nice right now, actually. It's just gorgeous here. Yeah. How are you doing?
Fantastic. Thank you. So, Justin, we got a lot to discuss in a short period of time, but before we get into it, why don't we just start with your newsletter, Uranium Insider. Give us a little bit of background on it.
Sure. We're the only investing newsletter that focuses exclusively on uranium. Been doing it since August of 2019. Our returns so far north of 500% for the whole portfolio. What we do is we provide a deep macro fundamental newsletter once a month. We do monthly members only webinars. We do one of those a month. That's a 2-hour deep dive into the sector for members only. And we also send out intra-month bulletins for trade alerts, macro moving fundamental alerts. And of course, you get all of our stock picks and the companies in the space where we have not only investments in companies, but also intelligently structured options trades as well. And I have a small dedicated team of professionals behind me. So it's been a wonderful experience so far, and we're looking forward to the coming years with it.
Justin, when we last spoke just over a month ago, I believe it was the day before the Russian invasion, and I was asking you why the uranium price was floundering. I believe at the time it was flat on the year, and here we are a month later, and uranium's up 30% on the year. And a big part of this move is on the back of the uncertainty of the uranium supply, and more specifically, the enriched uranium, which comes from Russia. And as a reminder to our viewers, 43% of all enriched uranium globally comes out of Russia. But why don't we just start here? First of all, tell us what the difference is between uranium and enriched uranium and why this is so important to the global markets.
Sure. Enriched uranium is just about the last, besides fabrication of actual fuel rods that go into the reactors, it's just about the last step in the fuel cycle. The fuel cycle takes anywhere from 12 to 24 months, depending on where the uranium is mined, but it comes out of the ground, goes through minimal processing, turning it into U3O8, uranium octoxide, or also known as yellowcake. That's the dry powder that is then converted into a gas at a conversion facility. That's UF6. And the UF6 is sent to an enrichment facility where it's spun in high-powered centrifuges that separates the isotopes to a certain level of enrichment. It then goes on to be fabricated fuel. And again, that does take 12 to 24 months, which is one reason why the commodity moves so slowly. So enrichment is sort of almost the last step in that process. And the reason it's so important is that a lot of times that utilities sourcing uranium and sourcing fuel for their reactors will skip those first couple of steps in the process, and they'll end up having to pay up for it, but they can get that needed fuel faster. And so when you have a disruption to enrichment, it has pretty severe implications for disrupting the entire fuel cycle because it is sort of that last step. And interestingly enough, to your point that Russia provides 43% of global enrichment, they're also north of 40% of global conversion. And conversion doesn't get as much attention because it's a smaller allocation in terms of percentage of the total cost of the fuel cycle for a utility. It's somewhere around 10% of the cost between all of the elements, but it's the tightest pinch point in the entire fuel cycle. And a big reason for that is the ConverDyn Metropolis plant in the United States went offline in 2018. We saw a big jump in conversion in UF6 at that time, and it stayed relatively high. Well, we've seen another 50% jump in the cost of conversion in the past 3 weeks. And all elements of that fuel cycle are actually in a strong uptrend right now.
And just remind us, so Russia supplies 43% of the enriched uranium to the world, but what percent of that goes to the US, or what percent of the US's enriched uranium comes from Russia?
I believe it's somewhere around 20%.
So it's a meaningful number.
It's a meaningful number, yes. With the US being the largest producer of nuclear energy and the largest consumer of uranium, it's definitely meaningful.
And just continuing on with the element of uncertainty of the supply of enriched uranium, Senator Barrasso from Wyoming is pushing for sanctions against Russian uranium. Maybe you can just give us your thoughts on this. Do you think it carries any weight?
It's hard to say. Yeah, Senator Barrasso has been an unabashed advocate of nuclear energy. And of course, in Wyoming, it's probably the most friendly jurisdiction in the United States in terms of uranium production. There's producing companies there currently, and a number of development companies. Barrasso introduced a Senate bill to ban the importing of Russian uranium just altogether. So that would need to not only pass the Senate, which has a chance, it would also then have to pass the House and then get the president's signature. Not holding my breath for all of that. The reason is there's implications for the actual stability of the grid if we entirely just cut off all deliveries coming from Russia right now. Now, the largest nuclear utility in the States, Constellation, used to be Exelon. They are actually in support of sanctioning Russian uranium, interestingly enough. However, it's very likely that there's at least one or two relatively large utilities in the States that possibly have near-term or mid-term delivery expectations coming from Russia, and an all-out sanction to cut those off would potentially actually harm the stability of the grid in the States. With that said, President Biden did sign an executive order banning any future purchases of any elements of uranium coming from Russia. So my interpretation of that as of now is that sanctions have not yet come to pass for the United States. Will they? I'm not really sure, but as of now, Russian uranium is not sanctioned. So existing contracts, existing deliveries can still be honored, but any further purchases of Russian uranium, signing of contracts is over from the United States at this point.
So if Russia supplies 43% of enriched uranium, where does the other 57% come from?
Oh, there's a number of enrichers. There's an enrichment facility in New Mexico in the United States. There's a number of enrichers in the EU. There's some enrichment facilities in China. I believe there's one in Kazakhstan as well. So there's a decent amount of enrichment out there, but Russia obviously is the biggest single player.
So let's move on to the ETF flows. And with this move that we've seen in uranium, it's up 30% on the year, give or take. And I know you follow the ETF flows very well. Why don't you just give us an overview, because I just want to get a sense of how much money has flown into the sector here just this month alone, and also in the past year.
Yeah, it's been really big in terms of ETF flows. The flows continue to come into the sector. We've seen just this year alone almost 600 million in mandated buying coming from the ETFs due to those inflows. We now have a combined assets under management of URA and URNM of almost $3 billion. And that AUM, just as an interesting note, was less than 200 million during the March 2020 lows. So it's absolutely exploded. And as I noted, I believe in our previous talk, and I note on my podcast pretty frequently, that we've been watching flows continue to come into the ETFs, even during the pullback in the sector, December and January. So money continues to pile into these things, and it seems like, considering all of those flows, I would honestly have expected the sector to have moved more. It looks like there's a decent amount of consistent selling that's meeting these flows. So somebody is adding into the ETFs consistently. Not somebody, it's obviously more than one entity. But in my opinion, I believe that quote unquote smart money is positioning into these ETFs, and retail is adding some selling pressure, kind of capping that movement. Just this general sort of risk off environment. I think that retail sort of potentially believes that uranium is not going to do what we just saw nickel do, what we've seen oil do, and that the commodities are going to spike and come back down. I think that nothing could be further from the truth. I think we're on the cusp of a really, really big move here, and all of the elements of the fuel cycle moving up are pointing in that direction.
So I just want to reiterate one point. You said in March of 2020, both ETFs had an AUM of 200 million?
Combined between URA and URNM.
And now it's over 3 billion?
Correct.
I wish you told me to buy in March of 2020.
Yeah, that was a buy anything moment, really. I mean, so many sectors have moved strongly since that point, but it's just wild to highlight the moves from there. Yeah, I mean, some of the individual stocks have done 20, 25x since that point too.
I want to move the discussion toward valuation now. Even though uranium's had a big move towards $60 a pound, many stocks have put in nice moves, also up 20, 30% or more. But a lot of them are still trading at discounts to their NAVs, I guess with the one exception being Cameco. I believe, depending on whose research you look at, it's trading maybe around 1.5 times NAV. But do you think we're going to see another run in the stocks given this move we've seen in uranium, or do you think they're fairly priced at this level?
I mean, if the spot price of uranium doesn't move, which I actually don't expect, I don't think we're going to see a whole lot of upside in the equities here. It seems like the equities are not discounting the potential for the spot price to move up more and drastically, which is what I believe is going to happen. Just putting all of these elements together, I think that uranium is ripe for a strong move, and the equities will move again at that point. Valuations are tricky in the space because so few companies, have ever or will ever produce any, meaningful cash flow, if any at all. So it's very difficult to judge valuations based on that, but it's still a very small space. We're still looking at less than 70 publicly traded companies, and most of these companies do at least have small allocations into the ETFs. And really, the flow of funds, if a fund wants to, I think that the SPUT vehicle will be sort of the darling of the investment flows. But if a larger fund wants to take a position in the equities, it's essentially going to be into the ETFs due to liquidity. And so, those ETFs then buy their underlying holdings and everything moves. So I think, honestly, the price of the equities is a screaming buy here relative to the spot price. It's bottomed out. It's made a double bottom. If you were to look at a chart of URA relative to U.UN and actually look at the equities relative to the spot price of uranium, it's made a double bottom here, and it's yet to really move. And there's major upside with the equities, in my opinion.
And I just want to focus in on one point that you just mentioned. You said there are only 70 publicly traded uranium companies in the world?
Correct.
And what's the entire market cap of those 70?
Oh, it's less than 45 billion here.
Right. So, and remind us again, how does this compare to the last cycle? I just want to get a sense of where we can go here.
It seems honestly to be moving faster than the previous cycle at this current moment, and that seems kind of ironic for anybody who's been in this sector for a number of years. It seems like things move just slow as molasses, but we had an absolute gold rush into uranium companies in the previous run, where we went from a couple dozen companies in 2004 to almost 500 in 2008. I mean, it was just an absolute rush into the space, and we aren't seeing that yet. We've seen a dozen companies pop up in the last 2 years, so it is happening, but we're not seeing that fervor and that frenzy come into the space yet. So that's different. But that also means that of the equities that are still in existence currently, the upside potential is probably greater, because there's literally just not very many companies you can invest in. So when funds really flow into the space, these stocks can really move violently.
And why don't you think we're seeing the move that we saw back in the last cycle?
You know, that's a really good question. Honestly, I think some of it has to do with where the broad market is relative to the previous cycle. We had pretty strong moves in the broad market leading up into the recession that happened in 2007, 2008. And so the commodities moved with the broad market going up. Now we're seeing kind of like a choppy broad market over the past few months. In just the global tensions that are happening right now, not only the Russian invasion of Ukraine, but just kind of geopolitical tensions across the board. High inflation, rising inflation. I mean, there's so many other macro factors that are affecting the space right now. So in general, it seems like there's a bit of a risk-off feeling overall affecting most markets.
So I have one more question before we wrap it up. As I mentioned on the onset, uranium is up 30% in a short period of time, and that's all on the back of geopolitics. But with such strong fundamentals coming out of the sector, Cameco announced long-term contracts of $40 million at the beginning of the year. That compares to $30 million in all of 2000, or 30 million pounds in all of 2021. France approving the construction of 6 additional nuclear reactors with the possibility for 8 more. And we have a big build out going on in China. Why isn't the price of uranium higher? Why isn't it at $75 or $100 a pound?
The price of uranium, for the most part, moves on actual physical demand for the product. There's no real futures market for uranium, so you're not going to see a geopolitical event necessarily move the commodity unless that equals buying around the commodity. So, for example, with the Kazakhstan unrest in January, we saw a jump up in the spot price because there was activity in the spot market. There were traders that were purchasing uranium, thinking that they could see some disruption to Kazatomprom's production. So when these events actually trigger buying in the market, then we see the commodity move. So because there's no futures market, essentially, that's why the price doesn't really react to news. The price reacts to physical buying. And so primarily in the spot market, that's been coming from the institutions. That's been coming from Sprott for the most part. Which is being, fed by institutional money. Sprott has raised $600 million this year alone. They purchased 11.5 million pounds since the beginning of the year. We're not even 3 months in. And so the market and the investors in the market, generally speaking, watch the spot price. So we have all of these other elements of the fuel cycle moving up, but the investors in the market, unless they understand the implications of that, don't really react to that. And so then you have kind of hot retail money that comes in on the sanctions, the sanctions news or the speculation, I should say. And so if we don't see the actual sanctions come in, there's probably going to be some money that's going to leave the market. And I think that's kind of what we saw today, because there was news about sanctions and uranium and oil and all that was left off of it. But this executive order banning future purchasing is having an effect, and we can see across the fuel cycle, including U3O8, it's in a strong uptrend. And so it's just a matter of time before investors broadly believe, okay, this is real, this is happening, and that's when I think money is going to pour into the sector.
And that's a very good point, but just a follow-up question. If we get some sort of resolution between Russia and the Ukraine, do you suspect we would get a pullback?
Yeah, probably. I think we'll probably see a pullback, but I think it'll be short-lived, because I don't believe that, well, first of all, I do hope that there is a resolution and it's peaceful and it's soon. But with that said, I don't really think that we're going back to how things were in January. I just don't think, the geopolitical shift that this situation has caused, I believe, is going to stick. And so it's unlikely that the utilities in the West, in the EU and in the United States, are going to just rush back into purchasing from Russia. I think that there's plenty of risk to that jurisdiction that will remain so going forward. So I don't expect the commodity itself and the fuel cycle to react necessarily strongly to that resolution that hopefully will come soon. So yeah, I honestly think this is a much bigger deal geopolitically. I think it has legs. I think it's a fundamental shift to how a number of different countries are going to be dealing with each other in terms of commodities trading. I don't think that's going away.
Justin, thank you for making time today. That was a great update on what's happening in the uranium sector, and there's always such great insights coming out of you. I would remind all of our viewers to check out Justin's newsletter, Uranium Insider. There is a link below in the description. Also check out his YouTube channel, Uranium Insider. He provides a daily update on what's happening in the sector. Once again, Justin, thank you.
My pleasure. Thanks for having me.
Hi, Paul. Thank you very much for joining us today. How are things in Beijing?
Hi, Jimmy. Thanks for inviting me. Just 8 more days and we are leading a normal life here. But the only problem is that we do have a little bit haze outside in the air today. So, I'm very happy that we are going to talk about the future of nuclear and uranium today, because I believe uranium is part of the cure for this kind of weather.
Yeah, that's great. I'm looking forward to this discussion. Paul, China General Nuclear Power, or CGNP, is one of the largest nuclear utilities in the world. I believe it's number 3. But many people in North America are not familiar with CGNP or CGN Mining. Can you please provide a brief overview of CGNP and how CGN Mining fits into the overall operations?
Okay. So yes, you are right. CGN, China General Nuclear Power, is the 3rd largest nuclear operator around the world, and that's accounts that is based on the reactors under operation. But based on the reactors under construction, I believe CGN is the largest nuclear constructor around the world. So we are not only the 3rd largest operator, but we are fast growing nuclear operator. I believe in the next decades, sooner or later, we will have the potential to become the world largest nuclear operator. And CGN not only doing the nuclear business, we are also one of the world leading renewable energies. We have a lot of, besides nuclear, we have a lot of solar, we have a lot of wind. Regarding CGN Mining is a subsidiary of CGN. So the purpose of established CGN Mining is to secure the uranium supply for CGN's faster growing nuclear fleet, because China is a country lack of uranium. So that's why we utilize CGN Mining to make investment around the world where is abundant of uranium and offtake the uranium to secure our own demand.
That's a great overview of CGNP and also CGN Mining, and I want to dive deeper into your operations. But before we do that, I want to touch a little bit on China. And given you're based in Beijing, Paul, you have an intimate knowledge of what is happening in China. Can you just speak to China's drive toward the nuclear power and the quest to reduce the use of coal?
Yes, I believe China has a very ambitious nuclear power program. It's not a secret. Everybody knows that. I think just like in the government's annual report in last year, Premier Leigh Curyer said that China will develop nuclear power actively and orderly under the precondition of safety. So also it has been made public in China's 14th five-year plan that we are aiming to have 70 gigawatts nuclear power under operation by 2025. That's a huge increase. If you compare it with the nuclear capacity we have by the end of 2020, that means 40% increase. And also, according to the China Nuclear Energy Association, the Chinese is targeting 100 gigawatts by 2030 and 150 gigawatts by 2035. And those gigawatts are for those reactors under operation. Besides that, we are targeting to have 30 gigawatts under construction by 2025 and 50 gigawatts under construction by 2030, and another 50 gigawatts under construction by 2035. So China is really very serious on nuclear. So a lot of people have been asking me why. I think the reason is very simple. because China is very serious regarding its commitment on the carbon peak and carbon neutrality. By the end of 2020, the Chinese government will make a very serious commitment in the UN that we are going to reach carbon peak by 2030 and carbon neutrality by 2060. Nuclear is the only solution. Like it or not, you cannot get rid of nuclear to do it. And as I mentioned, CGN not only doing the nuclear business, we are also a very renewable. We are a large corporation focused on the renewable energy. We have a lot of solar, we have a lot of wind. To be honest, for economy like China, including the European, the United States, they all have a lot of renewable. But renewable, they cannot serve as a baseload energy. So the economy cannot rely on too much of renewable. So regarding the coal, the gas, it has a lot of carbon. So you cannot rely on them if you want to reach carbon peak and carbon neutrality. So nuclear power is the only source of energy can combine the advantage of traditional fossil fuel energy and renewable energy. It's base loadable, it is clean, it is carbon free, and also I think nuclear is very cost competitive as well. So it is just some country haven't realized this point, and but I believe in the future more and more countries will get this point. They will come back to nuclear, just like what China is doing right now.
And Paul, I just want to put these numbers into perspective and just focus on the demand that might be coming out of China. And what percent of your electricity comes from the burning of thermal coal, and what percent comes from nuclear power?
Currently, about 67% of our electricity is coming from the thermal coal, and only 4.6 is coming from nuclear power. What is more is that actually the nuclear power's installed capacity only accounts for less than 3%. I think somewhere between 2.9%. But this 2.9% provide us the 4.6% of the overall electricity consumption. So we are utilizing a lot of nuclear here in China.
So once again, huge potential for upside associated with the uranium.
Yes, exactly. Because we kind of running out of river to build more hydro, and regarding the wind and the solar, I've mentioned they are not base loadable, and so nuclear is unavoidable if you want to reach carbon neutrality, carbon peak and carbon neutrality.
And how many nuclear reactors does China have right now?
China have I think 54 reactors is under operation right now. It's the third largest around the world.
Paul, does China have much in the way of uranium mining in country, or does it have to secure its supply outside of the country?
Okay, Jimmy. So China do have uranium mining activities here. So I think according to IAEA, China produces roughly 4 million pounds a year, but that is far less than the overall demand from the Chinese reactors. Currently, the Chinese reactors demands for 2,600 million pounds per year. So but we only produce 400 pounds a year. So kind of despite China produce some pounds, but almost all the Chinese reactors rely on abroad uranium.
I just want to clarify that. So internally, the mines in China produce 4 million pounds a year, but demand is for 26 million pounds?
Yes, 26 million pounds. Thank you.
Paul, that's a great overview of China and what's happening within the country and with nuclear power. But now I want to move on and discuss the mining operations of CGN Mining. Can you just tell us, why don't we just start with what your annual production is out of your two operations?
Okay, so we have two operations in Kazakhstan. So they produce altogether, they produce 6.7 million pounds in last year.
And can you just give us a brief overview of both operations, Ciampaglia Bay and also Ordolik?
Okay, so Ciampaglia have two mines, and one is called Ciampaglia Mine, and the other is called Urco Mine. And Central Ordolik have two mines. One is called Central Mengkuduk, the other is called Ciampaglia. So there are four mines together. 3 of them is under operation, Samsvai, Yuriko, and Central Mangkuduk. So altogether, these 3 mines representing more than 8 million pounds a year production capacity. But currently, we are only utilizing 80% of them. It's it's a policy from Kazatomprom. But next year, we are going to operate those mines under full capacity. And regarding Geopark has just obtained the subsidy use contract last year. So the subsidy use contract is like the mining lease in other countries. So the mining construction is going to start this year, and it will reach the design capacity by 2025.
So just to clarify, your 2 mining operations are both located in Kazakhstan, and you have nothing in country.
Yes, regarding the production capacity, the production mines for both of the 2 operations is in Kazakhstan, but we do have another asset in Canada. We own roughly 15% of Fission. Fission is the owner of one of the world's most advanced undeveloped high-grade uranium deposit, POS.
Paul, that's a great overview of your mining operations and also your development project, Fission Uranium. I want to move on now and discuss your trading operations. CGN Mining also owns one of the world's largest uranium trading firms. Can you just provide an overview of these trading operations, including how many pounds you trade annually?
Okay, thanks. Now, CGN Mining have a subsidiary in London. It's called CGN Global Uranium, and it is one of the top 3 uranium trading houses around the world. Last year, the trading volume is like more than 30 million pounds a year. So, it is huge. It is large. And, besides trading and the CGN Global Uranium, CGNGU, also serve as an exclusive agent for the selling of Husab product in the international market. And Husab is one of the world's largest uranium producer, one of the largest uranium mine around the world. So it's a very fast growing trading house.
And Paul, given that you are owned by a large nuclear power group, do you trade just to get supply for CGNP, or do you trade for other reasons?
No, actually, we are not trading to obtain supply. To secure the CGN's nuclear fleet, all the pounds came from our own production facilities. The purpose of the trading house, is to know more about the market, because CGN is one of the world's largest nuclear operator. We kind of have a big scale advantage. So that's why we believe, we can use this scale advantage to obtain more uranium and to provide this uranium to other small utilities around the world. So, the purpose of establish CGNGU is just to know more about the global market and to expanding the selling channel for the corporate. And in the future, I believe CGN Mining will not only have the capability to produce enough pounds for CGN, but also have some spare capability to feed other utilities. So at that time, we will need this CGNGU to sell these spare pounds to the utilities around the world, not only to China, but also to the utilities in Europe, in the States, to South Korea, to Japan.
Paul, there are many investment funds that are involved in buying and securing uranium. And last year, Kazatomprom also announced that they were going to get involved in a company called NexGen Energy. Will CGN ever start an investment fund that focuses exclusively on holding uranium?
Yeah, we have noticed that. No. Currently, I think the answer is no. We have no intention to take part in such activities because, our priority or our advantage is to operate mines, investment in mines, operate the mines, that need a lot of expertise. But to invest, the difference between invest in physical uranium and in uranium mines is that to develop a mine, you need a lot of expertise. But to invest in physical uranium is much more easier. As long as you believe the price is low, you can make the investment. But there's another difference is that to invest in uranium, you need to pay the cash. That's a lot of cash. And take a lot of money. But for that, the same amount of money, if you put it into the uranium project, you can buy at a relatively lower price. You can acquire more pounds, which means that you can create more value in the long run. So our priority, our strategy is to take advantage of the current market to acquire more uranium assets instead of just physical uranium.
Paul, CGN Mining currently trades in the Hong Kong Stock Exchange. Do you have any plans to list in another exchange like the London Stock Exchange?
We used to think about it, but given consideration to our current scale, we kind of it's not on our itinerary yet. And to be honest, I kind of like Hong Kong, and because most of our investors in Hong Kong, and they are very familiar with our company, and we speak the same language. And also, Hong Kong is a international capital center as well. The capital flow, there's no restriction, and a lot of investors from European, from the States, from Australia, they also make investment in Hong Kong. So we kind of, we kind of very happy with where we are today, but maybe in the future, I would think about to go to somewhere else. That depends on in the future. The current, the scale of the company, the reserve we have, the resources we have, I think Hong Kong is good enough for us.
Paul, as we wrap up, what can investors expect in terms of news flow from CGN Mining in the coming months?
I believe good news, a lot of good news. For instance, I believe, for instance, we finished the acquisition of Arch Lake by the end of July last year, and so if you look at our financial statement of last year, they are not fully they are not fully showed in our financial statement, but in the first half of this year, so the company is running at a much more higher price level with much more higher production volume level. So I kind of I believe maybe in the interim, after the interim, you will see a very fantastic operation result. Who knows?
Paul, I want to thank you and your team for spending time with us today and providing insights on CGN Mining and also what is happening in China with regard to their nuclear power program. Once again, thank you.
Thank you, Jimmy. My pleasure.
Hi, Askar. Thank you very much for joining us today. How are things?
Hi, James. Things are very well. Nice to see you again.
Likewise. Askar, when we last spoke 2 weeks ago, we spoke about the risk factors Kazatomprom is facing and the mitigation plans it has in place. But now I want to focus on your recently released financials for 2021 and also for the year ahead. Your 2021 financials highlighted many positive developments in a very challenging year. And I just want to touch on these. Maybe you can just give us an overview of your financials.
Sure. We released results last week, and as expected, for the lowest cost producer, that benefits as the uranium price improves. 2021 results remained very strong. We can highlight a number of developments. So the first one is a dividend payout, which is a little over than 350 million USD at the time of payment last July, which worked about $1.36 a share and a yield around 5% for a share price and exchange rate of the payment at the last day of July. So kind of obviously we cannot comment on the dividend for 2022 yet. on our results of 2021, as our board will be looking at the time of coming month to provide a recommendation to our shareholders at AGM in May, so very soon. However, as per our clearly laid dividend policy, the minimum recommendation will be 75% of a free cash flow, and it will be up to the board to recommend anything higher. So we'll have to wait and see what would be the final figures. So as we move into the improved uranium pricing environment, we're seeing so far in 2022 and see Kazatomprom's share price discounted. And under the pressure due to the risk of environment related to current events, it's important to remember that no producer in the world stands to benefit from the rising price as much as Kazatomprom. And unlike anyone else in the sector, that also comes with a clear dividend policy showing that the value we're creating is passed to our shareholders. So another point to mention is JV Ortalyk. It was great to see that the part of our agreement come to a conclusion finally with several years of discussions. Our Chinese partners paid a fair market value for 49% share of that operation, and in return for that partnership, we've got a fuel fabrication plant in Kazakhstan, along with a commitment to buy the full output of that plant for the next 20 years. And finally, yes, we did commit for keeping our production at -20% against our subsoil use contract through the end of 2023, and it has not changed for ourselves. So to summarize, we can say that we're at the stage of considering the strategy for 2024 now rather than for 2023, which is expected to be announced in the third quarter of this year, once we'll be preparing the budgets for the next year. And again, we will be determined just by the market conditions and by our contract portfolio.
So that's a great overview of 2021. Now, why don't we discuss guidance for 2022, just highlighting some of the key numbers, your production volume, your cost guidance, and also your all-in sustaining cost.
Sure. What you're seeing in 2021 is a widening of our expected ranges for several guidance metrics. This is done as a precaution measure related to current environment of elevated risks. With this approach, as the quarters will go and we gain more confidence in everything from supply chains to production costs and of course Kazakhstani tenge exchange rate, we will be narrowing those ranges for sure. So touching upon the exact metrics, I think the most important is to start with production. So we are expecting to have the range from 21,000 to 22,000 tons. That's for Western investors, and converting to pounds, it's 2.6 million pounds range, which is quite large, but I mean it all makes sense in the current environment. So the top end of that range is very similar to last year's actual production at -20%, but we've expected the down range to make sure that we incorporate all risks associated with supply chains, with mining plants. So all of them are inside of that lower range. As we have done since our IPO, we are targeting our sales again higher than our production, and expect to make up the difference either from our inventory or, as we did for the last 3 years, from market purchases as well. Our cost guidance is higher than our results for 2021, and similar to actual production. We included a wider range. So again, this accounts for the impact of supply challenges, supply chain challenges, inflation, exchange rates. So all of which are still uncertain in the current volatile environment. For financial metrics, it's important to note that we use the same FX and uranium price assumptions for our budget at the time when we were preparing those budget in August and September. So there was a lot of discussions internally around updating the values, but with the significant changes coming at the end of February into the March, we were very, very late in the entire consolidation and forecasting process. And it seems that the volatility is far from over. So with continued significant moves of the key inputs of currency exchange, of the uranium price especially, it made sense to wait for some level of stability, I would guess, before potentially pushing new assumptions through the guidance metrics. So that's kind of overview of our main guidances for.
Askar, the uranium market has experienced significant volatility in recent months due to the Russian invasion of the Ukraine. And I want to discuss the impact this is having on global uranium markets and also on your operations. And I first want to touch on the volatility in the Kazakhstani tenge and how that's impacted your financials. Maybe you can just touch on that for us.
Yeah, so as we discussed previously, we have not yet seen a direct impact on production, shipping, or sales so far. Supply chains are already difficult due to the pandemic, not because of the events. And actually the problems with Russian trade, of course, certainly does not help at all. So I think the most important message is that the company and management will do what is certainly needed to overcome all those challenges. If we cannot get uranium out of the Russian ports for weeks or months, we will use another shipping routes, which we have announced and communicated. This is a Trans-Caspian route. So we will manage our existing global inventory. That is also very significant, and we may engage swaps, location swaps with China to ensure that we meet our commitments. Going the other way, if we cannot get the key operating materials into our territory or through Russia or even through China, we will definitely source them from some other parts of the world. And that said, we understand that it could be slower and get kind of to the mines with some delay, and which may impact our development plans. It might be more expensive than when we use our normal routes. So these are all the reasons actually for us why we're showing the wider range of the production and costs. And as far as the tenge exchange rate, the weakness could have a near-term positive effect on our costs, but in the current situation, there seems to be a real inflation coming that we expect to catch up to us as like everyone else, which could result in a higher cost in actually mid to long term.
And just to clarify, so right now the uranium is still, any of the uranium that goes to the west is still being shipped through St. Petersburg. There's been no disruption.
Absolutely. Currently, we're using all the same routes as there is no direct sanctions on Rosatom or transportation through Russian territory.
And has there ever been a disruption in the delivery of uranium to your Western clients?
Well, let's put it this way. I mean, the reason for us to develop an alternative routes back in 2018 was a kind of disruptions that we have seen. Russia had experienced to organize a World Cup in 2018. You remember it. At that time, they've closed all big cities, and actually St. Petersburg was, which is the main hub for transportation, was also closed. So that period was almost 6 months, which was notified by the Russian government that they will not be accepting any Class 7 cargoes. So after we had seen those kind of developments, we decided to develop another routes, which we succeeded in 2018. So we have seen those kind of disruptions in the past, which are not related to sanctions, but to other different reasons. You know, that St. Petersburg is on the north. Sometimes that sea could also froze with a lot of ice, so this could also impact part of our deliveries in wintertime. So this kind of mitigation plans we started back in 2018, which made it very successful. In terms of supplies into the Kazakhstan for some spare parts, equipment, we're seeing some of the manufacturers that are unwilling to deliver to Russia, but we're negotiating with them on different routes where they could be delivering. I mean, at the end of the day, we have air cargo which could deliver that equipment to us.
Askar, the Russian invasion of the Ukraine has had an impact on both oil and also the global uranium markets. You mentioned the near-term price impact, but how has it impacted the term market and also the pricing in the term market? And I just want to get a sense of what's happening there with the utility companies. Has the market changed with the recent developments? Are you getting more calls from utilities looking for pounds? And what sort of terms are they asking for?
Yeah, thank you for the question. As I know that beyond the spot market, current ongoing events are driving elevated concerns about security of supply and access to nuclear fuel in the years to come. So utility customers are absolutely paying more attention to mid and long-term market, which is kind of Kazatomprom's focus and strategy. We're seeing elevated interest from utilities. The tragic and troubling developments in Ukraine have kind of end users thoroughly access the logistics of physical deliveries of uranium concentrates and nuclear fuel. Although this legitimate concern, which we share with our customers, we have entered this period of global volatility very well prepared. So Kazatomprom is very comfortably positioned to address our customers' renewed interest in securing inventory under medium-term and long-term contracts. We're also working side by side with our partners to mitigate risks under some existing supply contracts, stepping up the plate as a reliable supplier. Not only Kazatomprom produces Kazakh origin, but also our numerous partners as well. As such, our material is not only complies with the highest standard, but also is acceptable throughout all around the world.
Askar, in 2021, Kazatomprom also announced an investment in ANU Energy, a physical uranium fund. Can you just provide an update on this, please?
We had a number of announcements around that investment, and we're excited to see it moving forward and creating a financial opportunity for physical uranium investment in our part of the world. ANU Energy is not our subsidiary, but kind of a separate entity that we are invested in. Whether they will go to kind of private investors or they will approach capital markets. However, we do know that the initial $50 million raised from the investment of ourselves and National Investment Corporation will be used to purchase material from CAP. And this first initial kind of sales is expected in the second quarter of this year. So we will complete the first stage by selling $50 million stack, and then they will go for the second stage, raising the capital and collecting up to 500 million USD.
That's a great update. Thank you. I want to get your views now on the market and where the price is going. Right now, there's a lot of noise in the market, especially with what's happening with Russia and the Ukraine. But if you take all of that away, Askar, the underlying fundamentals for uranium are still extremely bullish. And if you want to achieve net zero, you can only do this through the use of nuclear power. Can you just speak to this, please?
Yeah, thankfully, our mining plants and production have really not seen a significant impact directly related to those events. We have seen kind of to the events and to their consequences that we have seen so far in 2022. The impact at the moment is still more related to the pandemic and to the supply chain issues that are developing. The January and ongoing events result in elevated level of risk, which required our entire risk management team and various internal departments to review and reassess probabilities and impacts to ensure our risk mitigation plans are actually robust. In some cases where a risk has been realized, such as sanctions against Russian banks, we took actions and kind of implied these risk plans. And in that case, we kind of immediately cutting off any relationships with banks under sanctions to ensure that our company and our JVs kind of could be protected from any secondary sanction exposure. A lot of what we've learned and the actions we took during the COVID-19 pandemic is now being used to enhance our flexibility and responding to the new risks that are emerging. In terms of the market, I think we're seeing further tightening of the near-term supply, which is impacting the spot price, and we're seeing that impact and the price discovery. That also drives elevated concerns about security of supply access to fuel in years to come. So utility customers are absolutely paying more attention to mid and long-term market, which we discussed with you. And again, because that's the main focus of Kazatomprom. Additionally, what we can say is with this pandemic going as a kind of becoming as a normal part of our life, we are going back to our travels. We started to see our clients, customers. We started these regular visits, and more discussions are being not on the spot market, not through brokers, but through normal negotiations with our sales team, their nuclear contracting teams. So we're seeing a lot of interest from both sides, and we're discussing the volumes. The volumes are much bigger than it was even a year ago. We're discussing terms of potential supplies, and they are actually going over 2030, which is also a good sign of a security of supply.
Askar, as we wrap up, you and your team traveled to South Florida in February to attend the BMO Mining and Metals Conference. And now that the world is opening up, what other marketing trips do you have planned in the coming months?
Well, we'll be engaging as much as we can. We'll be speaking virtually at the Cormark conference in April, and we expect to be in person for Cameco conference in California in May, as well as the big Bank of America mining event in Miami also in May. In the current environment where uranium price is strong and rising, Kazatomprom's share price remains under pressure. I think it's obvious that everyone loves a story or a rumor that, if true, could transfer value to smaller explorers and developers in the uranium sector, especially those who are not even expecting actual production or revenues for the years to come. But the rumors we keep seeing and hearing are actually that rumors, and the vast majority are false and driven by false and incorrect information about Kazatomprom and even about Kazakhstan. So our goal is to remind key stakeholders of our position in the industry by maintaining a strong communication and clear messaging every chance we get. So we'll use every chance to be communicating to investment community, to our clients, utilities, all the stakeholders. So you should expect us to see more face-to-face. And if we'll have possibility to do this kind of virtual events, we're happy to do so.
So you're going to continue to hit the road and see your investors, but you're also going to continue meeting with clients.
Absolutely.
Well, Askar, that was a great update on Kazatomprom, and I want to thank you for spending time with us today. Maybe I'll see you in Miami at the Bank of America conference, and you can buy me a drink.
Absolutely. That would be a pleasure. So thank you, Jimmy. Again, it was good to have another discussion, even though we had one a week ago, but the next one we should plan for face-to-face.
By all means. Once again, thank you.
Thank you.
Hi, Grant. Thank you for joining us today. How are things in Saskatoon?
Yeah, great. It's a pleasure to be with you again. And spring has sprung here in Saskatoon, as we say. So everybody's got a little bit of bounce in their step for sure.
Yeah, well, thank you for making the time. I'm looking forward to this conversation. Grant, Cameco released some very positive news in February, which included the restart of the McArthur River mine, which is the world's largest uranium mine. And it also announced the signing of long-term contracts of 70 million pounds. But before we discuss these positive developments at Cameco, I want to first start with the term market. You always say the real market is the term market, so that's where I want to begin. And because Cameco is the world's second largest uranium producer, you have insights that very few other people have. So I want to get a sense of how the current geopolitical situation is driving the term market right now. So maybe we can just start there.
Yeah, happy to make a few observations, of course. Ours is a market right now where there is a lot of uncertainty and there's a lot of change, and it's happening all at once. And, you know, I'm not going to sit here and pretend to have a crystal ball and tell you exactly how everything's going to play out. But what is crystal clear to me is that we are incredibly well positioned as Cameco to deal with the changes that are in the market. So ours was a market, you and I talked about it last time, where favorable fundamentals had really begun to take over, and that's what drove the contracting that we saw last year. It's what drove the McArthur restart decision. And I'm just going to work under the assumption that anybody who's dialed in today doesn't need to be convinced about those favorable fundamentals, the demand outlook improving, the supply outlook failing to keep pace, and not just primary supply, but also those secondary supplies, which always used to fill the gap in the market, are just not there to play the role that they have in the past. But the favorable fundamentals right now are colliding with what I think is a geopolitical realignment of the nuclear fuel supply. And it is profound, and it's going to have very dramatic effects, and we're only beginning to feel the effects right now. And so if we unpack that geopolitics a little bit, I would say the question is not if Western markets, and let me use that term really generally. What I mean by Western markets is North America, obviously, Western Europe, Eastern Europe, parts of Southeast Asia. The question is not if they're going to turn their backs on Russian supply. The question really is when and how fast. I mean, as you look across the different jurisdictions, there's really only one debate, and that is, will we have a sudden stop of Russian supply coming into the market, or will it be a ramp down in the shortest possible time in order to minimize any operating impacts upon nuclear power plants? Nobody wants the lights to go out. Nobody wants nuclear's resilience to be jeopardized. But that's really the debate. It's not, well, can we get through this and continue to buy those supplies? And let's just remind ourselves what's at stake. The Russians have global capacity in the enrichment space of 52%. Over half the enrichment market globally is the Russians. About a quarter of the enrichment service that goes into the US, about a quarter of the enrichment service that goes into the EU is supplied by the Russians. On the conversion side, the Russians have global conversion capacity of about 28%, and of which somewhere between 10 and 15% go into the US and go into Europe. So there's a very significant contribution Russia has made to global fuel supplies, and now the world is really quickly trying to disentangle from that. And there's going to be several determining factors to help us understand how quickly this can occur. And the first one, of course, is, well, there's going to have to be some destocking and some inventory drawdown in order to accommodate this. The Western demand just exceeds the Western capacity. So one place to turn is inventories. And I'm not just talking about inventories that sit with utilities. I'm also talking about the sort of in-process inventories that sit with the fabricators, with the enrichers, with the converters, and then, of course, with the primary producers of the product, which is uranium, to which we apply a bunch of those services. And we're just seeing a destocking right now. We're seeing utilities turn to flex up their fabrication contracts, flex up their enrichment contracts, flex up their conversion contracts, and all that's code for more feedstock. The world needs more uranium in the form of UF6 to feed into that void that will be created. And so that's a big challenge to figure out how that happens. Generally, when you see destocking, you also then see spot demand. You see utilities and different intermediaries jump into the market to grab any material that they can find. And so we're starting to see some of that spot pressure, and probably not build to old inventory targets, but probably restock to higher inventory targets. So that's kind of a second effect that we can expect to happen. And then, of course, what follows is the term purchasing, the full term contracting cycle that's going to call for the run rate requirement that excludes the Russian supply going forward. And what's interesting about the dynamic that we're watching right now from a geopolitical point of view is there's almost this assumption that it's up to the utilities or the policymakers in the Western world to decide how fast this is going to happen. And everybody's forgetting, well, the Russians actually get a say in this too. You know, we've seen a presidential decree from Russia talking about voluntary export restraints. What are those things Russia sends into the world that would cause pain points for those countries that are imposing economic sanctions on Russia? So it may not be the choice of the Western utilities or the Western policymakers. It may be Russia's choice to just not send the materials and sort of inflict economic pain that way. The other thing is, even if neither side goes with sanctions or retaliatory sanctions, secondary sanctions and tertiary sanctions are having a bite. It's very difficult to find somebody willing to logistically ship material that is coming from Russia. It's difficult to find somebody who'll sail into Russian waters. It's difficult to find an insurer who will underwrite those transportation links. And so there's all these cascading effects, and we just seem to be focused on the sanctions piece. But I tell you, we're feeling the effects already, and we're in the early innings of trying to untangle the Russian involvement in the nuclear fuel cycle.
So having said all of that, is there a premium on Western produced uranium?
Well, you know, I think the term market is changing in some fairly profound ways. And let me just remind you that I characterized 2021 at the time of our Q4. I characterized 2021 in the early parts of 2022 as really one where we were seeing three distinct changes in the term market. One was the tenors of term contracts were stretching out. Remember, in the past, We had an oversupplied spot market as other primary producers continued to produce material without a home and put it into the spot market. And they did that in a low interest rate environment. In response to that, fuel buyers were taking very short bites out of the term market, perhaps 2 years to 4 years or 2 years to 5 years, so they could really get that competitive carry trade, spot prices at a cost to carry, versus paying production economics for term material. But we saw tenors begin to stretch out in 2021. It wasn't uncommon to see a contract 2 to 7 years, 2 to 10 years even, really starting to stretch out. We saw time frames stretch out. Whereas in the past, utilities focusing on the carry trade might not have really been concerned about the end of this decade or beyond. I talked about in Q4, some of the business we did was 2030 to 2040. So we saw time frames stretching out. And then we saw volumes go up, not just because timeframes and tenors stretched out, but even bigger bites out of the market. So that was already happening because of the favorable fundamentals. And now with this geopolitical shift, what we're adding to this is an origin focus. It's pretty clear that some of the recent business in the market is looking to disentangle itself, not just from Russian services, conversion or enrichment, but maybe some sources of uranium that historically have been reliant upon the Russian fuel cycle, the material in Central Asia. So it looks like that some are focused on de-risking from not just Russia, but the Russian sphere of influence. So watch this origin piece. It's really important. And then watch the demand pick up from the various actors in the fuel cycle. I mean, one of the important RFPs in the market right now is actually from an enricher who's looking for a heck of a lot of conversion that, as far as I can tell, is not available in the Western world. So an enricher is out there competing with utilities for a conversion supply, which just all indicates that there's a pinch point in that conversion service, in that feedstock, and that's pretty suggestive of good opportunities for those of us with Western capacity.
So there's a couple of things you said, and I just want to clarify, but you mentioned that some people are looking for contracts as far out as 2030 and 2040. You as a producer, how do you price that up? Like, do you actually attach a price to a contract that goes out 10, 15, 20 years?
Well, I think you'll recall, and others who are listening to this will recall that Cameco has a very strong market-related bias right now. We just look at the fundamentals, the demand outlook improving. We look at the uncertainty around supply. We look at the challenges of bringing on new assets. I mean, anybody who has pounds under the ground, they may have been discovered, but they're not licensed and permitted. There's no construction plan. They're planning on building a project in a time where supply chains are in real crisis, where inflation is a real factor. We just think this all points to a structurally higher production cost economics for uranium, and we want to take advantage of that. So we have a strong market-related bias. We're willing to take a chance out in that market because we think prices are going to be stronger. So, for those utilities, we just simply say, let's just price it out in that window. That's when we want to do it, and that's when we're willing to part with our material. We've got a great asset base. MacArthur restarting, yes, but it, under its last life of mine plan, it runs for 22, 23 years at 18 million pounds a year. So we've got assets that live out in that window, great assets. So we're willing to take that chance. So we're not really stuck on pricing it today. Having said that, we could see a very significant price post at March month end from UXC or from TradeTech with some of the business that's been done, starting to get into those prices, where you can imagine a portion of the business to be base escalated, within a significant portion of it to be market related on top of that. So the market has shifted markedly in our favor from a negotiating point of view.
And is there a sense of panic with utilities given what's going on in the world? Like, is your phone ringing off the hook? Guys are saying, Grant, you got to give me 1 million pounds or 5 million pounds?
Well, I would say it's not panic yet. And we have a customer base that I would say doesn't panic, but they go into what I'd call a security of supply contracting mode. The good news is we're actually not even there yet. So yes, we are seeing lots of inbounds. We're seeing lots of inbounds on available conversion capacity in the short run. We're seeing a lot of inbounds on available uranium capacity in the short run in order to make sure the feedstock is there for utilities that are looking for other enrichment options. And we are beginning to see the conversations where some are stretching out their view and saying, okay, I've dealt with the immediate problem, but now I need to see a future where I am building up my supply chain from fabrication through enrichment, through conversion, through the uranium that really de-risks me from the consequences of this geopolitical stuff. So we're beginning to see that. We're not there yet. We're not at replacement rate contracting yet. We haven't seen utilities come with volumes that equal what they consume on an annual basis. And that's all great, because we're already looking at nearly $60 uranium in the spot market. And I'm sure that term market price is going to make a rather strong jump here at month end. And we haven't even seen the leverage on top of that yet. So actually right now is not when I want it to be in that kind of panic situation, because it takes time. We don't respond with our productive capacity to meet spot demand. It's not what we do at Cameco. That's not what a responsible uranium producer does. It works in other commodities. It doesn't work in uranium. When that spot demand tightens, you want it to tighten long enough to then capture those higher prices into long-term contracts that give you full cycle value. So we're seeing a lot of inbounds. I wouldn't call it panic yet. The true moment will be when we see above replacement rate contracting. That's still in front of us.
And where is the demand coming from? Are you receiving more calls from the US, from Europe, or Asia?
In general, the demand that we've been dealing with for the past several years has been global. It's all of the fuel buyers from all of the various different markets. But no doubt, in the last several weeks, it really has been what I defined earlier as those Western markets. It's been North American. It's been Western European as well as Eastern European, and that's a really critical piece as well. Those countries that had been looking to distance themselves from Russian supply for some time have now a major motivation to do that. So we expect to see terrific opportunities for us there. And it is the Asian customers as well who have taken a side geopolitically in this. So it is broad-based. And I think we're just waking up to the realization that they're not only all coming to the market at the same time, but they're coming to the same time. Different intermediaries in the fuel chain are also coming to the market looking for different components as well.
Grant, that's a great overview of the term market. I want to turn the discussion now to Cameco. You released your full year production or financials back in February, and you had a lot of positive news, including the restart of McArthur River. But what really caught the market by surprise was the long-term contracting of 70 million pounds of uranium, 30 million in 2021, 40 million in 2022. And I believe that 40 million was all done in the month of January. Is that correct?
Pretty much, yeah, pretty much.
So I guess my question is, what drove that demand in January? Because you did more in 1 month than you did in the previous 12.
Yeah, well, some of it was obviously driven by emergent issues. I mean, we saw some political unrest in Kazakhstan in early January, which our partner Kazatomprom did an incredible job managing through those events and ensuring that the sites, the uranium producing sites, were unaffected by what was going on there. But no doubt, the prospect that the country that produces 45% of the global supply of uranium was facing political and social unrest was a motivator. There's no doubt about that. But other contracts were just the culmination of the not just months, not just quarters, not just years, but the long time it takes to properly negotiate a contract in our industry. I mean, we've been talking about this pipeline of negotiations, off-market negotiations for some time, and this really was the culmination of some of those discussions. They just all kind of a bunch of them just wrapped up at the same time, and so it, I think a good indicator that there is interest. And this was all, this was all geopolitical with Russia and Ukraine. And so we're going to see this kind of next leg of demand building on these favorable fundamentals.
So the civil unrest in Kazakhstan was just the catalyst that really brought people to the table to close the deal.
For some of them, yeah, for some of them it was, perhaps something that just brought it to conclusion. You could imagine that we're talking about market related, and our utilities were in a mood where they wanted to fix a lot of prices because they had a sense the price was going up in the future, but they wanted to take advantage of being a first mover. And then that kind of event says, oh, okay, let's just get the deal done. Let's lock up those volumes and we'll take that market related exposure. But we did have a couple instances where we were sort of 2 weeks between origination and conclusion of a contract as well. So there was some that definitely were responding to the events in that part of Central Asia.
So you're going to be reporting your Q1 numbers, I believe, in May. Are we going to see another similar announcement?
Well, just like we've been talking about from quarter to quarter, our team operates under a very, very clear principle, and that is a quality contract beats a fast contract every time. We don't put quarterly goals or half-year goals or annual goals on the contracting team. We just say, get the best deal possible for Cameco and its owners. Give us as much full cycle value and full cycle leverage as you can possibly get us, and that's the goal. And if it takes more than a quarter, if it takes more than a half year or a year end, there's no tyranny of those dates. And so we still have a very big pipeline. We're adding to that, as you can imagine, given the geopolitical stuff that we just talked about. We're expecting a robust continuation of our contracting activities. And by the way, this shouldn't surprise anybody. When utilities go into security of supply mode, it really becomes an incumbents recovery. They tend to, first of all, and this is really the source of our leverage, they first of all, turn to their existing contract base. And many contracts have flex options. And so we see the flex up of contracting volume. So any market related contract we have not only flexes up with the market price going up, but then we also get a volume kicker as they pro-cyclically flex up. Second piece of leverage we have is utilities that are in a security of supply driven mode may have flexed up and hit their maximum flex up, and then they tend to come to their reliable suppliers and they say, look, I just need more volumes. We've got an existing purchase order. Let's add more volumes to it. Of course, the understanding is those are priced in a new environment, and only incumbents get that. This is not the time for utilities to be starting brand new contracting with a counterparty they've never dealt with. They're not in the mood to take CapEx risk, permitting, licensing risk. They're not in that kind of mood. They're in a mood to turn to those who already have licensed, permitted, existing brownfield capacity and can add more to their portfolio. And then, of course, as we talked about last time, all the pounds we left in the ground because of our supply discipline, those are pounds we haven't sold yet, and they're absolutely leveraged to the market. So no surprise that this is the type of response. We still continue to be very busy off market, watching the on-market RFPs pick up, but that off-market space is one where we can really create the full cycle value that we're talking about.
And how many RFPs would currently be shopped?
Well, what's interesting is we went for a very long period post-Fukushima where I couldn't count 2 RFPs in the market at the same time. And then last fall, we started to see competitive RFPs, US utility, a Southeast Asian utility in the market at the same time. Different turnaround, different urgency, different product forms, but at least it was signaling there's more than one person with demand in the market. And then as we entered 2022 and saw some geopolitical uncertainty in Central Asia, and now with Russia and the prospect of excluding them from the nuclear fuel cycle, just 2 weeks ago, we had 3 RFPs in the market at the same time, all due on the same day. And that's what creates that critical mass of signaling where utilities, kind of realize maybe their time to have a lot of leverage over the market is over, and the market is going through a transition. And many of them pivot to off market for the reasons that I just described with respect to our leverage, and some we'll just see in the market more frequently with RFPs, and a few of them just do a bit of both. But it is starting to build towards one of those critical mass moments where, you know, when the market seems soft, we just see that customer base leave together, and when the market starts to harden, they just kind of all enter together, and it's those moments that create the contracting opportunities we try to be strategically patient to leverage.
Grant, earlier you said we have not seen the start of the replacement contracting cycle. When will we see the beginnings of that?
Well, contracting begets contracting in our business. I mean, nothing tells a utility that it's time to get into the long-term contracting business like when others are doing it. And so the success we had last year and in the early part of this year, I think came as a surprise to many in the market who didn't realize that when we were talking about it, we had a very large pipeline of off-market negotiations. That's what we meant. And then we've seen some RFPs come into the market now, which is a very clear signal. Tenors are increasing, timeframes are increasing, volumes are increasing. That all creates that momentum where the signal is loud and clear that it's time to lay claim to future production of uranium, because if you don't, you might not have any.
Let's move on now to the restart of McArthur River. Great news for Cameco shareholders and also for the community. A lot of people are going to be going back to work. When it's fully up and running in 2024, how many people will that mine employ?
Yeah, so our plan is to obviously get that mine and the mill up and running at still a supply discipline rate. You'll remember in February we were talking about not bringing it up to full productive capacity, which is 25 million pounds a year, not even bringing it up to 18 million pounds a year, which is where it was when we closed it down, but bringing it back to 15, and at the same time pulling Cigar Lake back to a lower level of production. And that was all in accord with the contracting success we had. Of course, that was all pre-Russian invasion of Ukraine and the challenge of trying to exclude Russia from the nuclear fuel cycle. So who knows what the appropriate plan is, but what I can tell you is the appropriate plan is a function of building contract homes. I said earlier, we don't increase our production to try to capture transient, sometimes short-lived spot demand. We plan our production after we've captured those spot pressures into long-term contracts, and then we bring the production up to match it. So when those assets are up and running, we expect them to be around 750 employees, so absolutely a central contribution to the economy in northern Saskatchewan, direct employment, contractor employment, the business development that we drive through those operations. It really is great news for a province that is actually going to enjoy a fairly widespread commodity-driven bump here in the next couple of years with basically everything we offer the world pricing higher right now.
Yeah, so having said all that, do you foresee labor shortages?
The great news for Cameco is that for many years, decades, northern hiring has been an absolute priority for us because it was the right thing to do, including support for all the services that we procure at our mining sites from northern-owned businesses. What this has allowed us is actually a very stable base of skilled employees who are still living in Saskatchewan's north and who want to come back to work for Cameco, who haven't been persuaded to work in other industries in the province or move across the border to work in, say, the oil and gas industry in Alberta. So that investment we've made for many, many years, you know that when McArthur is up and running, we're Canada's largest industrial employer of Indigenous people. We're rewarded for all of those investments at times like this because we find just a great base of skilled, engaged employees who want to come back and want to work for Cameco. So we're not foreseeing any challenges there.
And Grant, maybe you can just take us through the timeline associated with the restart.
The key for thinking about the McArthur River mine restart and the Key Lake mill restart is just a reminder, we don't push these assets to meet spot demand. And I just can't say that enough. In fact, by definition, a typical term contract doesn't start delivery for 2 years out. So that affords us the opportunity to be very efficient and very deliberate in the decisions we make. And right now, as you hear time and time again across the commodity space, supply chains are a challenge. And supply chains are a challenge that's creating inflationary cost pressures. And we have no interest in chasing inflation here at Cameco. We don't have to chase inflation. So we're going to sequence that restart to really be as planful and strategic and as risk controlled as we possibly can be, with an eye towards those homes that we have for the production. So what we've said is that this year there could be as much as 5 million pounds of production, but it's actually only 1 million pounds of production at the McArthur River mine, because we got 4 million pounds of broken ore ready to go for when the mill can start commissioning. So all eyes are on the mill at Key Lake. The focus there is on finishing a couple of key projects that we've been working on to digitize and automate that mill and really set it up to be the mill of the future. Investments that we're very excited about. And then we put out guidance for 2024, suggesting those two assets will be at 15 million pounds a year. And at the same time, we'll toggle back Cigar Lake. We haven't put out 2023 guidance because we're not in a rush to do this in any other way except strategically, deliberately, and effectively.
And Grant, I just want to clarify one point. You said earlier that when McArthur is up and running, Cigar will pull back its production from 18 million pounds to approximately 13 million pounds annually. Why the pullback in production at Cigar?
Yeah, well, if you remember a really long time ago, back in February of 2022, when the world was a little bit different than it is today, we're still in supply discipline mode. We had a lot of contracting success. We make our planning decisions based upon the homes that we have under the contract portfolio. And based upon what we had signed so far, it made sense to bring back McArthur, but not bring it back at full capacity. And we were in a market where it didn't make sense to push ahead and continue to exhaust phase one of Cigar Lake without a clear sight to what we would do around phase two of Cigar Lake. And so no surprise, our joint venture partner in that mine agreed that neither of us had an interest, but things have changed a lot. The market has moved, prices have moved, a lot of demand on market and off market has begun to come our way. Those plans could now change for sure, but they were made in a pre-Russia Ukraine environment. Gosh, we would absolutely love to be in a position to bring those assets back to full capacity. Wouldn't that be wonderful? But we wouldn't do it until we had the homes for it. And that just takes time to build those homes. So more to come on what those planning decisions look like.
Grant, I want to move on now, and I want to discuss investors and what buy-side clients are doing. I believe it was just in the last couple of weeks, Caxton, a large macro fund based in New York, recently filed that it purchased $250 million worth of Sprott Physical Uranium Trust. Are you getting a lot more calls from hedge funds and long-only funds and family offices, given the move that we saw in 2021, but also in Q1 of 2022?
No question. And it is right across the board. We are talking frequently to the energy investor, the clean energy investor. We're talking to the geopolitical investor, the interest from the traditional mining investor that has always been the anchor to us. That has gone up as you look at this commodity and recognize that this challenge of building enough Western supply capacity to meet Western demand in a post-Russia world is a real challenge that's suggestive of prices still to go higher. For an incumbent producer with tier one assets, it puts us in a great position. So There is no doubt origination is up. Lots of inbounds, lots of introductory calls, and you know, it's just a symbiotic relationship with the financial investments, because you know, people want to understand the market a little bit better, so they talk to us, and then they go and they talk to folks like at Sprott or at Yellowcake, and that usually raises some additional questions which come back our way. And we're just finding the investor level of understanding is going up dramatically, especially on this key point that investors should never back a uranium producer that says their strategy is to dump into the spot market. And we're just seeing more and more investors who just get that. They realize it doesn't behave like other commodities.
So as I mentioned earlier, uranium was up 50% in 2021. It's up 30% in the early part of 2022. I'm not going to ask you where the price is going because I know you're not going to tell me. So I want to frame it in a different way, and I'm going to use a baseball analogy. What inning are we in?
Easy analogy for me to make because I used it in February. We're in the early innings. We're in inning 2, and no more than that. We have just begun to see the favorable economics. We weren't even at replacement rate term contracting on the favorable fundamentals. And now we have a bit of a crisis setting in, which is just going to drive additional urgency. And one of the things that I've been pointing out for some time is that I didn't know what the shock was going to be. I didn't know where it was going to come from, but I was looking at a market that had neither the primary productive capacity nor the secondary supplies to absorb a shock of any significant size. This market just was very vulnerable to a supply shock, and it's come now, and we've only begun to see the effects of trying to disentangle from the Russian fuel cycle. So we're still in the early innings of this game.
Grant, now that the world is opening up again, are you on the road meeting with investors and utilities?
We are. About 5 weeks ago, things just went back to normal. We've been on the road through North America, been on the road in Europe recently. I wear a lot of hats at Cameco. It's a privileged position that I'm in, but whether it's the CFO responsibilities or the responsibilities I have for global marketing, there's no lack of interest in hearing from Cameco and seeing Cameco. So yeah, it's busy again. It's great. I mean, ours is a small industry. It's relationship based. It's great to be back in front of customers. It's great to be back in front of investors and regulators and all of that. And certainly welcome, if this is the new normal, I certainly welcome it.
Is there anything else you would like to communicate to the market before we wrap it up?
You know, as always, a great set of questions. You really have your finger on the pulse of what's going on in this industry. But just maybe one last comment. I mean, I think people can all agree that all Cameco has done for the last number of years is exactly what we said we were going to do, which is be supply disciplined, be financially disciplined, not front run the demand transition with supply that wasn't yet required. And we're going to continue to do exactly what we said we were going to do, and we're going to capture full cycle value for our owners, and our strategic patience will be rewarded, and that's the plan.
And Grant, maybe you can just summarize what investors can expect in terms of news flow in the coming months from Cameco.
Well, news flow will continue to focus on performance on the contracting side, with the caveat that it's not quarterly driven, it's not half year driven. Obviously, we'll report on the success that we're having there. We'll talk about how things are going at McArthur and Key, and remind people that ramp up is for material that's already been sold, not for material yet to be sold. We don't play that game, and just continue to deliver on a strategy of appropriate supply discipline, appropriate financial discipline, and be strategically patient for this market to fully recover.
Well, Grant, I want to thank you for spending time with us today and providing great insights on both Cameco and the overall uranium market. Once again, thank you.
Yeah, thanks to you, and keep up the great work. I think this is a great series that you run, and we're just delighted to be a part of it.
Thanks again. Well, that brings us to the end of our Uranium Conference 3.0, and I hope you found it informative. Don't forget to subscribe to our channel, Bloor Street Capital, and hit that notification button to be kept up to date on future events. We have some amazing conferences coming up, and the best thing about this format is that you don't have to leave home, and it's free. Once again, thank you for your support.